So, guys, we are live. We are live now. Can you all hear me? Just drop a message if you can hear me, if audio video is fine to you. We are live. Okay. Audio video is clear now? Good morning, sir. Okay, ji. So, hello everybody and welcome to this full English powered batch for CA Final Direct Taxes and International Taxation. A very, very heartfelt good morning to all of you. Before starting anything, just take a long deep breath. Just take a long deep breath and message me how you all are doing. A new start to a week, an energetic start to a week. How you all are doing, just message me out. Just message me out for a minute. Just tell me how you all are doing. Sir, we are very energetic. We have with us Monica, we have with us Satish, we have with us Lubna Mohammed. Hello. Okay. We have with us Dia. Many people joining one by one. Okay. Sir, we started off with capital gain day before yesterday. That is on very first lecture. We started off with capital gain. Shouldn't we revise what we studied yesterday? Sir, felt very good after India won. Great doing, sir. Great going. Absolutely good. And it should be the case. You should be good going. You should be good going because you have nothing right now to be worried about. Okay. Results are already out. Exams are yet to come. You only have to study. In between, whatever things rejuvenate you, you have to do that. Be it a cricket match, be it a Holi, be it any festival, whatever rejuvenate you for some time, do that. It's worth doing. Okay. Instead of using mobile phone, which actually does not re-energize you, whatever re-energizes you, now just do that. Yesterday's cricket match was very uh delight to heart to watch. Okay, so I really was. I didn't do any work yesterday. I was supposed to do work. I was having too much of deadlines, but I didn't do just because I wanted to relax myself. My last week was very tiring. So I thought to give myself a break and I did not do anything yesterday. So it's okay. I believe it's okay to not to do anything. So that's all what I wanted to say. Okay, sir. Okay, sir. We got your point. We absolutely got your point. Let us revise what we studied yesterday, sir. We started off with the cost of acquisition yesterday. And then we came on to special cases. Then we came on to exemptions and then we came on to tax rates as well. So there was a lot of things that we did yesterday. Why shouldn't we revise it once? Just participate with me. Next 10 to 15 minutes, I will take in revision. It is worth doing. Understand, it is worth doing revision. I know it is a revision batch. Difficult to process that. So in revision batch also you are revising. But it is worth doing. Okay. Sir, whenever you take cost of acquisition of any capital asset now, price paid to acquire that asset is the cost of acquisition. In addition to that, any direct expenditure incurred is also considered part of cost. Any cost incurred to obtain the clear title is also considered as a part of cost. But any STT paid is not considered. Any expenditure whose deduction has been taken under 24B or deduction taken under any head of the chapter 6A, you are not allowed it as cost of acquisition. Good morning, Jayashri. Then, if any asset you become owner of the asset on account of exempt transfer, then cost of acquisition of previous owner is taken. If you buy any intangible asset, then price paid is cost of acquisition. If you have any depreciable asset, then WDV is the cost of acquisition. If you have any very old asset, then first April 2001's FMV and cost of acquisition, whichever is higher, becomes your cost of acquisition. If you have any bonus shares, by default cost of acquisition is nil. But you get benefit of FMV as on 1st April 2001 as well. And if such bonus securities are listed, then you get FMV of 31st Jan 2018 as well. If you have right shares, normally price paid to acquire the assets is the cost of acquisition. In addition to that, if you renounce that, then whatever renouncement money you get, that is short-term capital gain. On the other hand, the person who buys the renounced share, his cost of acquisition would be price paid to company and price paid for renouncement. Then we came on to cost of acquisition of sweat equity shares was FMV on the date on which option is exercised. And at last, in case of demerger, cost of acquisition would be the proportionate net assets it received. That proportion should be multiplied to share price divided by the number of shares that the swap ratio is. On that basis, you would get the share price in case of demerger. Then after that, now we came on to special cases, which was ULIP taxation. We understood that if it is ULIP or it is LIP, if ULIP is having annual premium more than 10%, then sir, it is taxable under that capital gain. If it is within 10%, then if such ULIP is issued before 1st April, 1st Feb 2021, it is exempt. But if it is issued after 1st Feb 2021, then aggregate ULIPs up to 2.5 lakh would be exempt. Beyond that, every ULIP would be taxable under the head capital gain only. If we have LIP, if having premium more than 10%, premium more than 10%, in that case, it is taxable under IFOS. If it is within 10% limit, you have to check. You have to check if it is issued before 1st April 2023, it is exempt on maturity. If it is issued after, then only LIP whose aggregate premium is up to 5 lakh will only be exempt. Otherwise, it won't be exempt. Sir, any maturity received on death is always exempt. In addition to that, ULIP would be taxed under 112A. We understood example as well. Then we came on to slump sale. Sir, whenever you sell a business for lump sum consideration, in that case, it is called slump sale. Sir, slump sale will become long-term capital gain only if it is you held for 3 years. If it is held for less than 3 years, it will be short-term. We need 3 things in slump sale. First of all was FMV1, second was FMV2, and third one was net consideration. FMV1 implies FMV of the assets given. It can, if you have given any building, then take SDV. If you have given any shares, then take FMV. If you have given any painting jewelry, then take open market value. Whatever the other assets that you have given, take book value of that. And whatever the liabilities you have incurred, just reduce that. This will give you FMV1. FMV2 would be FMV of the assets received. If you received the cash, then take that cash. If you received the shares, then take FMV. If you received any jewelry, take open market value. If you received the building, take SDV. This will give you FMV2. FMV1 or FMV2, whichever is higher, will become your cost of acquisition. You have to reduce the net worth. What is net worth? Sir, net worth is nothing but cost of acquisition. If you have any depreciable assets in your undertaking now that has been transferred, take the WDV of that. Any revaluation done in this has to be completely taken care of. That has to be ignored. If you have any other assets, take at book value. This will give minus liabilities, of course. This will give you net worth of the undertaking. You require a CS certificate as well. And there were 2 ways to save the slump sale taxes. We have already discussed. Do the demerger or buy the subsidiary. It will save you slump sale taxes. Then we came on to 45(4) and 9B. We understood 2 pointers. Listen carefully. 9B talks about if partnership firm distributes any assets to the partner. Assume it is sold to an outsider, then whatever capital gain or whatever PGBP that turns out to be, now that shall be taxable in the hands of the firm. This is section 9B. Section 45(4) simply states that if partner is due some money, if you pay anything beyond his capital, and that is taxable under 45(4). But whatever extra you are giving him now, it will be double taxation. So we apportion such capital gain into different revalued shares in the ratio of the revaluation. Of course, difficult to digest in a minute, but don't worry. The more you understand, the more it will be able to process. We took this example as well. This example is given in question bank as well. I will share with you this example. Same to same example is given in question bank as well. Then we came on to liquidation. Sir, whenever we have shares of a company and company liquidates, there is no taxation in the hands of the company. Rather, entire taxation is in the hands of the shareholders. First of all, whatever the money shareholder received to the extent of accumulated profits shall be considered as deemed dividend. And whatever the money that shareholder received, that is also considered as full value of consideration for the purpose of capital gain. Minus cost of shares would give the capital gain. But sir, There happens twice the double taxation. So whatever the amount that has been considered under deemed dividend shall be reduced while calculating the capital gain. Then we had 50AA. 50AA talks about three securities. First of all was market linked debentures. The debentures in which rate of interest is dependent upon any underlying asset, that is considered as market linked debentures. Second thing, specified mutual fund. Any mutual fund issued on or after 1st April 2023 whose exposure to equities is only up to 35% are called specified mutual fund. Third thing was unlisted bonds and debentures. Sir, any bonds, debentures redeemed, transferred, or matured shall be considered as short term only on all of these securities, whether these are long term capital assets or short term capital assets. We do not care. We only care that capital gain on these securities would be short term. Transfer of securities held in demat implies whenever you have hold securities in demat, the cost of acquisition shall be taken on FIFO basis. If you have advance money forfeited, then if advance money is forfeited after 1st April 2014, it is taxable under income from other sources. If it is forfeited before 1st April 2021, it is taxable under the head. Sorry, it is not actually taxable under the head. Rather, it is reduced from cost of acquisition. Whatever the cost of acquisition of the property is, that will be reduced. But sir, if you forfeit and somebody else transfers the property, in that case, it is not reduced. Then we came on to exemptions. First exemption was section 54 exemption, which talked about if you are an individual HF who transfers the residential house property and has long-term capital gain, buys a residential house property in India. You can even buy two if your capital gain is up to 2 crore rupees. You have to buy within 2 years or get constructed within 3 years. So you can even buy 1 year prior. Then whatever the capital gain is, cost of new asset or 10 lakh rupees shall be exempted. You should hold this property for at least 3 years. Otherwise, whatever the exemption claimed earlier was shall be reduced from cost. So even you can buy two adjacent properties, get the necessary modifications done and consider it as one property. Section 54B talks about if you have any urban agriculture land that has been sold but has been used by you for 2 years, whatever capital gain you get now, that will be exempted if you buy urban agriculture land, if you buy rural agriculture land. Sir, within 2 years from the date of transfer, you should be buying. Whatever the capital gain or cost of new asset you have incurred, that will be exempted. In addition to that, you should hold that property for at least 3 years. Sir, if you if you sell urban and buy rural and again sell rural, there will be no capital gain implication in your hands. Then we came on to 54D, which talked about if you have any land building of industrial undertaking and that has been compulsorily acquired, what happens in that case? Sir, any capital gain would be exempted in your hands provided you buy land or building for industrial undertaking within 3 years. Then we came on to 54EC, which talked about any person selling long-term capital assets being land or building. Then any capital gain would be exempted if you buy the bonds of 6 companies, namely NHAI bonds, PFCL, RECL, IRFCL, HUDCO, or IREDA. If you buy any 6 bonds, then your capital gain would be exempted to the extent of 50 lakh rupees. Within 6 months from the date of the transfer, you should be buying the bonds. You should never convert this bond into money, or neither you should sell these bonds for at least 5 years. Payment done within 6 months is important. Allotment can be done later on as well. And at last we understood in this point was, sir, even if capital asset is long term but capital gain was short term, still you would be eligible for exemption. 54, if we understood that if any individual HUF transfers any asset other than residential house property, you can sell gold, anything, land, commercial property, you would be exempted from capital gain provided that you buy residential house property in India. Your capital gain exemption would be long-term capital gain multiplied by cost of new asset divided by net consideration. This would be your capital gain exemption. You should be buying that asset within 3 years from the date of the transfer. And you should be buying within 2 years, getting constructed in 3 years, and hold for at least 3 years. Some basic condition: the day on which you are buying the property, now you should not hold more than one property at that point of time. Then we came on to 54G and 54G. These were easier. You are transferring from unit from urban area to rural area or urban area to SEZ. Whatever the cap gain you are arrived at in case of plant and machinery and land or building, that will be exempted. Here also it would be exempted. Then we came on to 1037. This was about Amravati people. We don't have to understand. This is not that relevant. Section 1037 was important. What this talks about? Section 1037 says if you have any urban agriculture land, if you are individual HF, you have urban agriculture land and that is compulsorily acquired. And RBI pays the compensation and that it would be exempt. Later on, we came on to tax rates. Sir, we have four different types of tax rates. First of all is 112A. If you sell any equity shares on which STT has been paid at the time of purchase and sale, if you sell an equity oriented mutual funds or business trust unit on which STT has been paid at the time of sale, in that case, you get a benefit of 12.5% tax rate over 1.25 lakh of capital gain. Sir, STT paid is important, but sir, in three cases, even if you don't pay STT, you get benefit. For example, you bought securities where STT was not even applicable. For example, you bought IPO, you bought in ESOPs, you bought securities way back at that time STT was not even in force, or you bought securities from recognized stock exchange IFSC where STT is not applicable. So in these three cases, now whatever capital gain you arrive at, it will be even eligible for 112A. These three pointers you can skip out. Sir, whenever you sell 112A securities, now you get a special cost of acquisition benefit. Sir, what is that special cost of acquisition benefit? Sir, your cost shall be considered as FMV as on 31st Jan 2018 or sales price whichever is lower compared to cost whichever is higher. This will be your considered cost of acquisition. Now important term is how do we arrive at FMV? Sir, FMV shall be if securities are listed as on 31st Jan, we shall take the highest trading price on that day. If not listed, for mutual fund, you would take FMV. For other assets like shares, like businesses, you would take index cost of acquisition. Then we came on to what is considered as equity oriented mutual fund. Any mutual fund which invests at least any mutual fund that invests at least 65% of its proceeds into listed equity shares of domestic companies shall be considered as equity oriented. If not, if you are a mutual fund who invests out of 100 rupees, 90% have been invested in a mutual fund which in fact invests 90% into listed equity shares of domestic company. These two are called mutual equity oriented mutual fund. Then we came on to section 111A, which says on the same three securities, if you have short term capital gain, it would be taxed at 20%. Then we came on to other STCC, which talks about any other short-term capital gain would be taxed at slab rate. 112 talks about any other assets. If you are selling and you have long-term capital gain, it would be taxed at 12.5%. Then we came on to if you are a resident individual or HUF, you transfer immovable property acquired before 23rd July 2024 and sold thereafter, and you have long-term capital gain, now, your tax calculation will be done differently. Your tax calculation would be done your tax calculation would be done like 20% with indexation and 12.5% without indexation, whichever is lower. Then we came on to the concept of indexation, which was if you have transferred, this is an old provision, this is a really old provision. If you transfer any long-term capital asset before 23rd July 2024, then instead of cost of acquisition, you would take index cost of acquisition. Index cost of acquisition. How do you index that? Take cost of acquisition divided by the cost of inflation index of the year of acquisition, multiply it with the cost of in year of CII of year of transfer. If your asset is very old before 2001, then in that case you would take the FMV as on 1st Jan 2001. So in case you sell immovable property, remember then FMV cannot exceed the SDV. That is important condition. So any improvement, if it is there, improvement shall also be indexed. But any improvement done before 1st April 2001 shall be absolutely ignored. There were 3 or 4 securities on which indexation was not applicable. That is 112A securities, that is bonds and debentures. In case of slump sale, in case of non-resident, we do not index at all. Even before 23rd July 2024, we never index that. Were you able to recall? Monica says, sir, your voice and body movements in the lecture do not look synchronized. Is it? See, sometimes it happens that my voice comes differently, my face. Sir, please consider the never stop the beat. Oh, ho, 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 ho. Is it really the case to everybody that my body and I mean, this is something very new I am listening. I mean, I am saying hi. I mean, my voice is coming first, or my hands are not synchronizing, or is it personally me who is not able to synchronize things? Is it personally me, or is it the software issue? Just let me confirm. Hello. It seems fair now. Sir, not personal. Okay. Arey, first of all, na, I thought that you are blaming me. Sir, you are saying hi. Sorry, you are saying yes, and you are making face like this. I felt like you are blaming my expressions, my actions. At first, I thought that. If it is technical issue, honestly, I don't have much things to know. It is software issue. Okay. Take it. At first, I really thought, yeah, my actions are not synchronizing with my hands. It's like I'm saying yes, you have to do I felt that way. I really don't know, Monica, how to settle that. I really don't know. I have right now connection which is working at nearly 70 Mbps, 860 Mbps it is working. I am really not aware. You can do one thing. Just pause the video, close the YouTube video and come back. It sometimes happens at YouTube end as well. Okay. Sometimes it happens at YouTube and YouTube's end as well. No, sir, voice is coming first. Okay. Just close the video, reopen that video again. It normally gets settled after that. Okay. Today I want to teach you something very special. So every day is a special day. What you are saying. I know, we know. Every day is a special day. Sir, in the case of special listener, we have four more special cases. In the last session, we understood that there is a concept of indexation. If you remember, there was a concept of indexation. Indexation was applicable if asset is transferred before 23rd July 2024. Correct? Yes. If you can all agree with me, that indexation is applicable when you transfer asset before 23rd July 2024. In your case, in your attempt, previous at 25-26 applicable. I do it many times, but can't work, sir. Just let me check from my end if anything I can do. Okay, I'll try to go slow. Jayashree and Monica, I'll try to go slow. I'll not use my hand expressions at all. Okay, I'll not try to use that expressions. Now listen, there are certain cases. What I was saying. Okay. Huh. There is a concept of indexation. If you transfer any asset before 23rd July 2024, then instead of cost of acquisition, you take index cost of acquisition. We are aware of this thing. But sir, for your attempt specifically, previous at 25-26, asset would be transferring in this case only. If you remember the charging section, the first definition, any gain arising from transfer of capital asset shall be taxable under that capital gain in the year in which transfer took place. That means capital gain would be taxable in the year in which transfer is taking place. That means for your attempt, capital gain computation would be asked for previous at 25-26. That means transfer should take place in previous at 25-26 only. For capital gain computation purpose, transfer should take place in previous at 25-26. Yes. If transfer should take place in this year only, then there is no concept of indexation available right now. Because right now we don't have any indexation left now. Right now we are not, we don't have any concept of indexation left now. Except for that tax calculation for 112, we are not left with any indexation concept. Because for capital gain to be taxable in previous at 25-26, transfer should take place in previous at 25-26. Here comes four exceptions. There are four exceptions, Section 45 fund, which specifically state that it is possible the transfer took place in some old previous years. But at that point of time, now we could not tax because of nature of those transactions. So we have to tax them right now. It is possible that there are certain transactions which took place in some previous years. It might be 2021, it might be 2022, it might be 2001. It might happen that transfer took place in some old previous years. But tax is applicable right now. So there are greater chances. Mind it, you have greater chances that if transfer took place before 23rd July, you might have to index as well. You might have to index. And this is the gray area I am finding out that examiner was going to test this time. Examiner is going to test this time. What are those four cases? Assume first thing is destruction of capital asset. You know what? One day, me and my wife went to Switzerland. We had a dream house. We had a dream house at Malad, at Mumbai. We had a dream house. It was acquired on 1st April 2001 for 25 lakh rupees. Me and my wife went to Switzerland just to enjoy. And all of a sudden there came a phone call. Rahul sir, Rahul sir, Rahul sir, your house is under fire. My house was under fire. I was crying. My entire trip was lost. I was crying because my house was under fire. What do I do? What do I do? What do I do? Do you know what? My wife was still laughing. She was laughing like crazy woman. She was laughing because behind my back, she had taken insurance of this house. Behind my back, she had taken insurance of this house. Now, what is the significance? Just imagine this fire broke on 1st April 2021. 1st April 2021, the fire broke. Can I say that in 2021 only transfer took place? Destruction of capital asset is a transfer. Yes, you all will agree with me that destruction of a capital asset is a transfer. And transfer took place in 2021 only. But government cannot legally tax me in 2021 na, because I have no money. At what price they would tax? I have no money. And I am also not certain that I would receive any money. Government cannot tax me. Na? Government cannot tax me. So this is the first exception where transfer has taken in some other year. But tax is going to be charged in the other year. So transfer takes place in the year of destruction, whereas asset is being taxed in the year in which compensation is received. Remember, compensation is received. For example, compensation from insurance company is received on 15th May 2025. That is previous year 25-26. Example, compensation received is 1 crore rupees. How do we calculate cost full value? How do we calculate the capital gain? Sir, for calculating capital gain, full value of consideration shall be insurance claim, whatever insurance money we receive, and that shall be full value of consideration, that is 1 crore. Sometimes what might happen, these insurance company do not give you money. They give you a brand new house. In that case, FMV of that house shall be considered as full value of consideration. What will be the cost of acquisition? Sir, cost of acquisition shall be my original cost of acquisition. But sir, since transfer took place before 23rd July 2024, we might have to index that as well. We might have to index that as well because, sir, because before 23rd July, indexation was there in force now. Indexation was there in force now before 23rd July. So we might have to index divided by 100 into CII of 21-22, what it was. I really need to check that. It is given here. It must have been given somewhere. 2021 was 301. Okay. 75.25. That means capital gain would be 24.75. So this will be my capital gain. This will be my capital gain. Got it? Got it? One question I want to ask from you all. One question. The clear participation is required. How much would be period of holding for me? Sir, should I take period of holding from 1st April 2001 to 21, that is 21 years? Will that be my period of holding? Or I will take period of holding from 1st April 2021 to the year of insurance receipt. What shall be my period of holding? 21 years or 25 years? What shall be my period of holding for determining whether it is long-term capital gain or short-term capital gain? Remember, very carefully answer this. Huh? Very carefully answer this. Beautiful, Monica. Sir, always period of holding shall be considered up to the date of transfer. We are legally owner up to the date of transfer, so period of holding shall be 21 years only and not 25 years. So remember, this is important. This is important. Now, the most important thing, sir, what will be the tax rate applicable to this? What will be the tax rate applicable to this capital gain? Can anybody tell? Can anybody tell me what will be the tax rate applicable to this? I'm telling you the old provisions. Huh? Can anybody tell me the tax rate applicable to this? Very controversial topic. A very controversial topic it is. In real life also, yesterday on, I guess it was Saturday, I talked with BOS and they clarified regarding the same. What will be the tax rate applicable to this? What will be the tax rate? Beautiful, 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 Monica. Beautiful. Monica says, sir, 20% LTCG. Because Monica is aware about the old provisions. If you remember, if you know, LTCG 112 clearly states that if any asset is transferred before 23rd July 2024, tax rate would be 20%, but we get benefit of indexation. But if it is transferred after 23rd July, that is on or after 23rd July, in that case, we get 12.5% tax rate, but no indexation is allowed to us. Since in our case, transfer has taken before 23rd July, we have got indexation as well. Our tax rate should be 20%. But on the other hand, if you look at the ITR portal, if you look at the answers by ICI, they have taken 12.5% because it is ambiguous in the industry as well. So even if you don't know about 20% tax rate, 12.5% is corrected by ICI. This was even asked in, I guess, in Jan 26 exam paper. They had given the alternate solution as well, and they have charged tax at the rate of both of them. They have given both the answers. No, no, not beneficial, not beneficial, not beneficial. Satish, transfer took place before 23rd July. So ideally 20% tax rate should apply. Ideally 20% should apply logically. But ICI gives answer in both the cases. ICI has given answer in Jan 26 attempt for both the pointers. If you have taken 20% with indexation, then too they have corrected that. If you have charged 12.5% with indexation, they have also corrected that because it is ambiguous in the industry. If you look at the ITR portal now, they charge 12.5% on every capital gain. They do not charge 20% in any way. Got it? Ideally, what you should be doing, you should charge 20% only. You should be charging 20% only because legally 20% is the case. If transfer took place before 23rd July, then 20% should be the case. Got it? Did you understand the first exception? Destruction of capital asset. The case where transfer took place before, but you received insurance money later on, therefore tax would be charged in the upcoming year. Second special case. The second special case is conversion of capital asset into stock in trade. For example, my mother had a house. My mother had a piece of land bought. When I was born, my mother bought a piece of land for me because she knew that I'm not going to do anything in future. I grew older. I realized, oh, my mother has bought a piece of land to me. When she bought the piece of land, it was bought for say 80 lakh rupees. When I grew old, I thought, what is there kept in CA? What will I earn? What will I earn? Of course, I will earn respect. Of course, I will have CA before my name, but at most, I can earn 10 lakh, 11 lakh, 12 lakh, 15 lakh package at first. Even after rank 18 lakh, 20 lakh package. But what if I become a real estate developer? What if I become a real estate developer? I will earn in millions. I will earn in crores. So on 1st April 2020, I decided to quit CA and converted this land into stock in trade. I converted this land and started getting the houses constructed. I constructed houses. Small, beautiful 2 BHK flats I have created and started selling those houses. Provision says the date on which you convert the capital asset into stock in trade, that shall be considered as transfer. But just think of it legally. Taxing on the date of transfer would not make much sense now. How can they tax me on this date? How can they tax me on this date? Because I have just converted that. I have not received any money. It's just a mere change of thought. How can I be taxed because I have not received any money now? So provision says you will not be taxed right now. Rather, you would be taxed when stock in trade is actually sold. When stock in trade is actually sold now, then only you will be taxed. And remember, whatever the proportionate capital gain is, whatever proportionate stock is sold, you will be taxed proportionately. Sir, for example, on 31st Jan 2026, half of the land was sold. Half of the land. Sir, how do we arrive? For example, property was acquired or for 80 lakh rupees. On the date of conversion, you have to look at one thing. FMV of such property. FME of such property. It might be, say, 1.4 crore rupees. It might be 1.4 crore rupees. In that case, what would happen? Sir, you have to calculate capital gain from this date to this date. You have to calculate capital gain. How will you calculate? Sir, full value of consideration shall be FMV on the date on which asset was converted. That means on 1st April 2020, whatever the FMV of the houses, FMV of the houses 1.4 crore. Cost of acquisition, index cost of acquisition. Sir, if property is acquired before, if property is transferred before 23rd July, then cost of acquisition shall be indexed as well. So here indexation shall also apply. Indexation shall also apply. Whatever the 80 lakh rupees property we had acquired, we would divide by CIA of 160, year 16, multiply by 20, whatever it turns out to be. Nearly it would turn out to be 1 crore. So capital gain would be fixed 40 lakh rupees would be fixed the capital gain. Whenever this piece of property is sold, for example, it is sold in 2025-26, and whatever the amount it is sold, for example, it is sold half. So out of this 40 lakh rupees, half would be taxed. Half of the capital gain would be taxed in previous year 25-26. Remember, the portion we would sell, the portion of cap gain that the property we would sell in the year, that portion would be eligible for, that portion would be taxed in that year. If we sell one third of the land, one third of the houses in 25-26, one third of the capital gain would be taxable. Whatever the proportion we sell now, that proportion only will be taxed in that year. Again, tax rate would be 20%. Ideally, 20% tax rate should apply. Then, sir, we got your point. We got your point. Absolutely, we got your point. If you remember, there was a section. If you remember, Sir, you had only told that if we have long-term capital asset being land or building, and you transfer that, you can even claim exemption under 54 EC. You remember? Do you remember? Under 54 EC, you can claim exemption as well, if you remember. But sir, for claiming 54 EC, now we had certain issues. Certain issues. You have to buy bonds within 6 months from the date of transfer. Date of transfer is 1st April 2020. Date of transfer is 1st April 2020. You have to buy bonds within 6 months. Sir, how come I buy? How can I buy? How can I buy? Overacting Pro Max. How can I buy from this date? I have not received any money. I have not received any money. How can I buy, sir? How can I buy? In that case, not provision actually, but CBDT comes up with a clarification that in case a stock in trade is converted into, sorry, capital asset is converted into stock in trade, now you don't have to buy the bonds within 6 months from the date of transfer. Rather, you have to buy bonds within 6 months from the date on which the stock in trade is sold, because money is realized at that time only now. So you get a relaxation from not buying from 6 months from the date of transfer. Rather, you have to buy within 6 months from the date of actual sale of stock in trade. Okay, a relaxation. Beautiful, Monica. Sometimes you all must be wondering where you all are stuck, where you have gone stuck. All of a sudden, out of nowhere, I come up with poor set of acting, very poor set of acting. Sir, another point, at whatever value the books have been, at which books have on in which books are recorded, now we don't care. What does that mean? Sir, for example, I had acquired piece of land for 80 lakh rupees, and its FMV is 1.4 crore rupees on the date of conversion. But in books of accounts, I have recorded it just 80 lakh rupees. Will it matter in any way? Right answer is no, sir. It will not matter. It will not matter. At whatever value the person is writing in its books of accounts, it is not relevant. The actual FMV shall be determined, sir. It can be based on valuation report of a valuation officer, or a registered valuer like chartered accountant, or anybody like merchant banker. It can be any valuation report. Third thing, third special case, compulsory acquisition under any law. See, important point here is what I'm trying to tell you is, if transfer took place before 23rd July, now you might have to index. In these four cases, now you should always keep in mind, always keep in mind that there might be a scope where you have to index the cost of acquisition. You might have to index. That is important. That is what I'm trying to do. That is why I'm going slow. These are four cases now which are based on old provisions but yet relevant in real life. Therefore, in this case, now just be careful. If transfer took place before 23rd July, now you might have to index. Got it, sir. Got it. We got your point. Compulsory acquisition under any law. You know what? I have not told you this. I have not told you this. Or did I? I don't know. You know Riddhi madam, that IDT wali mistress, Riddhi madam, IDT queen. Her husband, her husband has a fee. I mean, what do we call farms of opium? Her husband has farms of opium. These opium farms were acquired on 1st April 2020, not 20, but 1st April 2001, for just 25 lakh rupees. Her husband acquired opium farms. Where did he acquire? In the outskirts of West Bengal. Outskirts of West Bengal. Riddhi madam's husband has opium farms. Do not tell her. Whatever she teaches, na, it's just to convert her black money into white money. But her real earning comes from opium. Her husband's her husband has a helipad in her house, in a village. I mean, in a small town. She has helipad on her house. One day, he was doing good. He was doing good, earning crores of rupees per annum. Crores of rupees per annum. It was 1st April 2020, where Didi said, "Who is Didi?" Mamta Banerjee said, Eno Cholbe, how can you do this to us? How can you do this to us? How can you sell opium in our city? She compulsorily acquired the property. She said, I will take the property and get a temple constructed. Durga Devi temple we will get constructed at your opium farm to purify this house, to purify that area. Oh dear God. Oh dear God. On that day, she announced that she will give compensation of 1 crore rupees. She said that she would give 1 crore compensation. Sir, do you think person earning crores and crore rupees would be satisfied with 1 crore compensation? No, he immediately went to court. He immediately went to court. He immediately went to court to get the compensation enhanced. Even 1 crore compensation was not paid, sir. 1st May 2025, he got first installment of 50 lakh rupees. On 1st June 2025, he got installments of 50 lakh rupees. First June to the 1st May 2026, half installment of 50 lakh was received on 1st May 2025, and half installment was received in next year 26. And he had also gone to court, and court awarded compensation on 1st May 2032, that is 10 crore rupees. Court awarded that 10 crore rupees, and even court also gave the interest of 1 crore rupees. What was the case? Opium farms of Riddhi Madam's husband were compulsorily acquired. The first thing that government announces is nothing but the initial compensation. The first thing that government announced, the initial compensation that government gives to everybody, that is initial compensation. How do we tax this initial compensation? Sir, initial compensation is taxed in the year in which first installment is received. Remember, very important point up. Most people do this point wrong. Initial compensation is the first compensation that government announces. When it is taxed, sir, it is taxed in the year in which first installment is received. Sir, when did she receive first installment? She received her first installment in previous year 25-26. Previous year 25-26. How much would be taxed? Sir, full value of consideration would be entire initial compensation, not the first installment. She received the first installment as 50 lakh rupees. But when we are going to tax that, entire 1 crore of initial compensation shall be taken. Entire 1 crore of initial compensation shall be taken. Cost of acquisition, of course, 25 lakh divided by 100 multiplied by 289, whatever it turns out to be, we would get that. Nearly it would be 74 lakh rupees. It would be something like that. Cost of improvement, nothing. Long-term capital gain, it would be long-term capital gain. It is the initial compensation. You might get initial compensation in multiple parts, but it would be taxed in the year in which first installment is received. In addition to that, sir, what if we receive the second installment? No tax. No tax. Because entire initial compensation was taxed in the first installment. So when you receive second installment, no tax. Sir, what about this enhanced compensation? Provision says this enhanced compensation will be taxable as and when received. The date, the year, the time, the moment it is received, it is taxed. For example, it is received in previous year 32, 33. At that point of time, previous year would not even exist. At that point of time, tax year would exist. Provision says whatever the enhanced compensation is received, 10 crore, that would be taken. Whenever enhanced compensation is received, you do not get cost of acquisition because entire cost of acquisition was taken at the time of initial only. So no enhanced compensation. But if you have incurred any litigation expenses, that would be allowed. This would give you long-term or short-term capital gain. Okay. Sir, it is pertinent to mention that if initial compensation is long-term capital gain, then enhanced compensation would automatically be long-term capital gain. If initial compensation is short-term capital gain, enhanced compensation shall also be short-term capital gain irrespective of the year of receipt. Irrespective of the year of receipt. Now, two more points, two more important pointers. Sir, whenever we receive interest in case of compulsory acquisition, our property is compulsory acquired, we receive compensation. We also receive interest on late compensation. Provision says whenever you receive the interest on this late compensation, it is taxable under income from other sources, and you get a standard deduction of 50%. That means whatever you receive, now only half of it is taxable. If you receive 1 crore, half of it is taxable. If you receive 2 crore, half of it is taxable. You get a standard reduction of 50% on this interest. And sir, sometimes what happens? Listen this point very carefully. I'm telling you a real life example, real life in situation. See, Riddhi madam's husband acquired property for 25 lakh rupees. Every year he used to earn 2 to 3 crore rupees from this property. Every year he used to earn. Correct. He used to earn 2 to 3 crore rupees of asset earning. Now this property was taken over by West Bengal government on 1st April 2020. And initial compensation announced was just 1 crore. Only 1 crore of initial compensation was given. Everybody was laughing at this compensation. Everybody. Even the judge in the court now was also laughing. 1 crore compensation. The person who is earning 2 to 3 crore from this property, he is given only 1 crore of compensation for entire land. You think now, you are earning 2 crore, 3 crore from an asset and you are being just given 1 crore for that entire asset. It is absolute waste of time. So court also knew that court will have to give the enhanced compensation. Court knew that some or the other enhanced compensation is to be given. Court already knew. So court at that point of time now passed an interim order that pay 3 crore rupees of enhanced compensation right away. Whatever the remaining enhanced compensation is now, we would tell when we will pass the final order. Right now, give away 3 crore of enhanced compensation. So what did I say? Sometimes court also give the interim order for enhanced compensation. Interim order for enhanced compensation. It is not a final order, but court knows that some or the other day they have to pay more enhanced compensation. Court knows. In that case, court passes an interim order. Provision says if you receive any enhanced compensation on account of interim order, it is not taxable. It is not taxable. When will it be taxed? It will be taxed in the year in which you receive the final compensation, or sorry, you receive the final order of the court. In that year, it will be taxable. What did I say? If enhanced compensation is received due to interim order of the court, it is possible that court knows that we are supposed to receive more money. Court passes an interim order to award us some enhanced compensation. Provision says any interim order enhanced compensation is not taxable unless there is a final order. Received to us. Got it, everybody, or not? Got it, everybody, or not? So sometimes what happens now? For example, 1 crore compensation was given to us. 1 crore compensation was given to Riddhi madam's husband. Court saw. Riddhi madam's husband went to court. Court saw. Oh, you are playing with the lives of the children. Chi. You are selling opium. Oh, ho. Court was angry. Court said 1 crore. You should be getting just 50 lakh of compensation. 1 crore is also enough. 1 crore is also enough. You should get 50 lakh compensation. Can court reduce compensation? Court might reduce. Compensation. In that case, what will happen? Sir, rectification has to be made. Whatever capital gain that has been already paid by you, that has to be reduced. Whatever taxes you have paid, that shall be reduced. In addition to that, you have to refund the money. Whatever the cases, you have to refund. But yes, rectification will be made. These 2 pointers we have already discussed. Sir, sometimes what happens is, for example, there is person A whose property has been compulsorily acquired. Now, to receive enhanced compensation, he went to court, but court goes on date to date, tarikh pe tarikh, court goes on date to date. It might happen that you receive enhanced compensation after 20 years. At that point of time, you are not even alive. So, whenever your legal hire receive the enhanced compensation, it would be taxed in their hands. Done, sir. At last, sir, if you receive any compensation under section 96 of Right to Fair Compensation, Transparency, Land Acquisition, Rehabilitation, Resettlement Act, it is exempt. What did I say? If you receive any compensation under section 96 of Right to Fair Compensation, Transparency, Land Acquisition, Resettlement, Rehabilitation Act 19, whatever it was, to 2001 it was, I guess. If you receive any compensation on this act, it is exempt. Sir, how do we remember? You don't have to remember. I am telling you now. If you see a very big name, right to compensation, a big name, big actor name, and it is mentioned section 96 now, it is exempt. You just have to remember that. You don't have to remember the name. Now, this was the third special case, compulsory acquisition under any law. Sir, important. This is really important. My inner sense says that this case is going to be asked in exam. Inner sense says, because indexation is also probable. Indexation is also can be asked. In addition to that, in initial compensation, they can even trick you. They might give initial compensation into pieces. They might give you interim order of. They might give you interim enhanced compensation as well. So it has multiple cases that can be tested. Okay, I'm not giving ideas to ICI, but my internal feeling says that it can be asked. Okay, 3 pointers were to be considered: initial compensation, enhanced compensation, interim enhanced compensation, and interest. These 4 pointers are to be considered. You will be able to solve. Fourth special case. Fourth special case. Sir, transfer of property in case of joint development agreement. Means in North India, na, like in Gurgaon, there is a beautiful developer, and not a beautiful developer, a very big developer who has developed the entire Gurgaon. It is DLF, if you have heard of that name. In Mumbai, Pune side, na, there is a person called Lodha who has developed the entire city. Do you have any such developer in South India, Hyderabad, Bangalore? For example, there is a person called Lodha. Okay, let us assume Lodha developer is there who develops a house. For example, we have Mr. Satish. We have Mr. Satish. You know what? Satish is born rich. Satish is born rich. How born rich? He has a piece of land, 5 acre, or not 5 acre, 1 acre. 5 acre is too much. 1 acre. If you understand 1 acre, I don't know. It is nearly 44,000 square foot. 44,000 square foot property Satish has. Oh wow, sir. Oh wow. Satish has 44,000 acre of square foot. Square foot? No, 44,000 square foot of property, but no money. No money. When he used to look at his pocket, only coins would come out. But he's the owner of 1 acre property, 44,000 square foot. How can he get money from this? He transferred this property to a developer. Developer named Lodha. What Lodha would do now? Lodha would construct the house, construct the building, and in return he would pay some money, plus return some flats. For example, he constructed 20 flats. Out of that, 4 flats are given to Satish. It is possible. 4 flats. This concept is nothing but joint development agreement. I have property, you have resources. I give you property, you construct the house and return money and resources to me. Return money and flats to me. That is done in joint development agreement. No. For example, this property was transferred on 2016. This property was transferred in 2016. If you remember the definition of transfer, so definition of transfer clearly states that if you hand over your immovable property to somebody else, in part performance of the contract, now it is considered as transfer. You remember? You remember, if you hand over your property to somebody else in part performance of the contract, it is considered as transfer. If you remember, in that case, ideally it should be taxed in 1617 only. It should be taxed in 1617 only, but provision says no. We give a benefit to individual and HUF. Right. Mention. It is mentioned. It is only benefit to individual and HUF. This joint development agreement is available to individual and HUF only. If you are an individual in HUF and he transfers the property under joint development agreement, transfer would be considered in the year in which property is handed over to developer, but tax would be charged in the year in which Mr. Lodha gets a completion certificate. Completion certificate. The day he receives the completion certificate is the day in which he would be charged to taxes. Now, how much taxes would be charged? See, Satish would be such a capital gain in the hands of Satish would be in previous year in which completion certificate is received. How much capital gain? Sir, full value of consideration shall be money received plus if he receives properties. So SDV of the flats, whatever things he received shall be considered. For example, he received money of 2 crore rupees plus 60 lakh into 4 flats. That means he received 4.4 crore rupees he received. 4.4 crore worth he received. Whatever the cost was, we would take that. Whatever the indexation required, we would do that. And capital gain we would arrive at. Done, sir. Done, sir. Only case. There is no special, there is no complexity in this case. No complexity. Only thing you have to consider is the year in which you transfer is the year of transfer. The year in which you hand over the possession is the year of transfer. But the year in which he got the completion certificate is the year in which taxes would be charged. Important here is whatever we receive, that would be considered as FVOC. If we receive cash plus if we receive property, then SDV of the property plus cash would be considered as full value of consideration. This is considered full value consideration minus cost of acquisition. This will give you capital gain. Done? Clear? Clear to everybody? I have to tell you two more pointers in this case. Two more pointers. Two more important pointers which are to be carefully understood. So first of all, this benefit is not allowed to companies and other assessees. For example, if company transfers in 2016, then capital gain would be charged in 1617 only, irrespective of money received or not. If any other assessee does the same thing, it would be charged in 1617 only. It would be charged in 1617 only. Government is not going to wait. Second thing, sir, what if Satish is so cruel, the word is cruel, he's so cruel that in 2016 he transferred the property to Lodha developers. He is due to receive flats, he is due to receive money. He is yet to receive the money. But in 2020, he sold the flat. He sold the flats. Is it possible? See, just think of it logically. I have given my entire land to Lodha developers, and in 2025, I am assuming that I would receive the flats, I would receive money. I am assuming that I would receive in 2025. What if Monica comes to me in 2022 and asks me, Rahul sir, can you give me these flats? I sold these flats to Monica in 2022. I sold these flats. Can I sell it before receiving? Can I sell flats before receiving? Yes, sir, I can sell. If I transfer these properties before receiving or before completion certificate, provision says you will not get the benefit. The year in which you would transfer, in that year only you would be charged to taxes. That means this benefit is available only to you when you wait till completion certificate and you transfer properties after completion certificate. But what if you transfer properties before completion certificate? Will you get any benefit? Right answer is no, because bottom line is you are given benefit because you don't have money right now. You don't have any assets right now. That is why you are given this benefit now. But if you get money after selling this flats, then no benefit would be given. Got it? Important pointer, important pointer. Now tell me one more thing. Last pointer before this topic ends. For example, Satish receives 2 crore rupees plus 4 flats of 60 lakh SDV. That means he received 4.4 crore rupees. What if he sells one flat for 1.5 crore? One flat for 1.5 crore. What would be the cost of acquisition for this one flat? What would be the cost of acquisition for this one flat? What would be the cost of acquisition of this one flat? Sir, will it be 60 lakh, the SDV, or will it be 1.1 crore? That is total consideration divided by 4 flats. What will be the cost of acquisition of this one flat? Try answering, try answering. It might be wrong. It might be wrong. Sir, if we receive money and we receive flats as well, both the things we are receiving, and out of that I am selling just one flat, what will be the cost of acquisition of that one flat? Will that be alone SDV of that flat, or will that be total consideration divided by number of flats I received? Beautiful. Dia says 60 lakh. We are say 60 lakh. And right answer is yes, it is 60 lakh only. It is 60 lakh only. But I have seen this students doing mistake, doing 1.1 crore. So a humble request, the plot you are, the flat you are selling, now take SDB of that relevant flat only. You might be wondering who would do this mistake, but number of students have done this mistake. Number of students. Got it? Must be very careful. SDV of the relevant flat shall be taken as cost of acquisition and not the entire for consideration divided by number of flats. Okay? This is the area of mistake that students do. That is why I have told this. This was the fourth special case. Fourth special case we understood in which transfer might take place in some other year, but tax would be charged in some other year. Destruction, transfer would take place in the year of destruction. Tax would be charged in the year of insurance receipt. Second point we understood was conversion. Transfer would take place in the year of conversion, but tax would be charged in the year in which actual stock in trade is sold. Third, compulsory acquisition. Sir, compulsory acquisition, whenever takes place, transfer would be considered at that time only. But tax would be charged in two cases. First of all, initial compensation when received, first installment is received, and second, when enhanced compensation is received. Fourth case was in case of joint development agreement for individual HUF. If we transfer such property, it would be transferred, but we would be taxed in the year in which completion certificate is received. Done, sir? Done, sir. Just come on to the chart. Where do we stand right now? Just come on to the charts. Where do we stand right now? Sir, we understood basics. We understood computation. We understood full value of concession. We understood cost of acquisition as well. Then we came on to advanced cases. At this point, we understood how do we compute capital gain. Then we came on to exemptions. How do we save capital gain? And then we understood how do we tax such capital gain. Everything we understood. Then we came on to some old provisions like indexation. We came to section 45(1) exceptions as well. We understood exceptions as well. Oh wow, sir. Now we are only left with some basic pointers. Come on to next topic, that is exempt transfer. Directly come on to exempt transfer. At last we'll do this. At last we'll do this. Come on to exempt transfer. Some focus. See, of course, this is the last topic, almost last bigger topic for the chapter. But that does not mean that your attention can deviate. No, it is not allowed to be deviated. Okay? When you read the definition of transfer, there are multiple cases happening. It might be a sale, exchange, relinquishment. Anything can be transferred. Handing over the possession or compulsory acquisition. It might be conversion. It might be destruction. Based on the definition, you might have multiple instances which are covered under the definition of transfer. But section 47 lays down certain criteria on which might look like transfer, which might look like transfer, but it is not considered as transfer. Which might look like transfer. Every feature appears to be like transfer, but it would be an exempt transfer. It would be an exempt transfer that there can be no tax implication on these cases. Important list. It is important list. Earlier also I used to say this important. Today also I say this list as important because in Jan 26 attempt this was asked as well. So be careful, huh? Sir, first of all, distribution of capital asset on total or partial partition of HUF. What does that mean? For example, Mr. A. A has three children. A is A1, A2, A3. A is having an HUF. Okay. Yes. Yes. And I will tell you how do we tackle it. I will also share with you. Huh? I will tell you how do we tackle it. A is HUF. Huh? A is HUF. There are three children. Third child got married. Third child got married and got separated from his father's HUF. Got separated from his father's HUF and created new HUF, that is A3 HUF. Provision says this is partial partition of HUF. Now, when he is getting separated from father's HUF, he would get some property. Provision says any transfer of asset on account of partial partition of HUF shall be exempt transfer. Ideally, A's HUF is transferring assets to A3's HUF. Now, in this case, it should be transferred, but provision says it is an exempt transfer. It should be transferred, but not a taxable one. It is an exempt transfer. Similarly, A has three children: A1, A2, A3. A died and passed a will. In that case, since it is total division of HUF, total partition of HUF, now provision says whatever the assets A1, A2, A3 are receiving, that shall be exempt transfer. That shall be exempt transfer. Oh wow, sir. Oh wow, 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 wow. Simple, 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 simple. Transfer of capital asset under gift will by individual HUF. For example, today only I announced that whoever scores 90 plus marks in DT, I will be giving my entire house, the house in which I live, to that student. You have a motivation to score 90 plus in DT. Whatever house that I stay in, I will give that house to you. If I announce that, I will not even charge a rupee from you, not even a token money, nothing I would charge from you. No registration charges, only of course registration charges seller has to incur. Anybody who incurs the registration charges will be paying that. So I will not charge anything. I will give my house away, gift. I will give away my house free of cost to those who score 90 plus. If I give away, if I give away any capital asset, na provision says it is an exempt transfer. Gifting is an exempt transfer. Remember, you might give gift to anybody. You might transfer your assets under will to anybody. For example, I write down that if I die, my entire property would become property of Satish. If I write that will, that is also exempt transfer. Wow. But sir, till last year, na, everybody who used to transfer na would was an exempt transfer. But right now we have only individual HUF who have this feature of exempt transfer. That means if company gives any gift to you, it is not an exempt transfer for the company. Third thing, sir, listen to this point carefully. If there is a company or there is a subsidiary of such company, if there is a company or and there is subsidiary of such company, which subsidiaries are 100% subsidiary, parent company and 100% subsidiary company. Provision says if parent transfers any asset or subsidiary transfers any assets, anybody transferring any asset to other person, it will be exempt. Parent company transferring any asset to 100% subsidiary, 100% subsidiary transferring any assets to parent, it will be exempt transfer. It will be absolutely exempt transfer, provided it is not stock in trade. You are not transferring stock in trade, because if you are transferring stock in trade, then PGBP would apply. Na? Exempt transfer is for the capital gain purposes. Na? If you are transferring stock in trade, then PGBP would apply. Therefore, no relaxation for stock in trade. Second thing, the person to whom you are transferring should be resident. If subsidiary is transferring to parent, then parent should be resident. If parent is transferring to subsidiary, subsidiary should be resident. They should be resident. In addition to that, so the person to whom you are transferring such assets now, the 100% parent subsidiary relationship should exist for 8 years from the date of transfer. This 8 years should be there. 100% parent subsidiary relation should be there. And last point, the recipient should not convert such asset into stock in trade. Four conditions attached. Huh? Four conditions attached. You have to transfer a capital asset, not stock in trade. Second thing, the recipient should be the resident one. Third thing, 100% parent subsidiary relationship should continue for 8 years. And at last, sir, the recipient should not convert that capital asset to stock in trade. These four conditions are to be met. If you fail, that exemption shall be withdrawn and tax will be charged in the hands of the transferor in the previous year transfer took place. Oh, that means if company has transferred any asset in 2018 and later on in 2024, the subsidiary converts such asset into stock in trade, sir, it will be charged in the hands of the parent company in 2018 only. In 2018, rectification would be made in 2018, and in 2018, tax would be charged. Oh wow! Does it seem like a very difficult pointer? Does it seem like very difficult pointer? The same points were mentioned in old book as well. I mean last year as well. But people do not read this point. Let's see. Let's see. Come on to question bank. In question bank, towards the last, you have a paper for Jan 26. Okay. In last, you have Jan 26 exam paper amended for Finance Act 2020, Finance Act 2025. A Limited is an Indian company, is a wholly owned subsidiary of another company, E Limited. E Limited is the parent and A is subsidiary. And that to 100% subsidiary and that to resident. Okay. On 10 2024, October 2024, A sold a plot to E. Subsidiary sold plot to E. Oh. Okay. For 35 lakh. That means full value of consideration is 35 lakh. Okay. Plot was purchased in 2010 for 15 lakh rupees. For A, it was cost of acquisition was 15 lakh. Transfer was 35 lakh. Year in which transfer took place was October 2020. Okay. On 1st Feb 2023, he converted such plot into stock in trade and fair market value was 60 lakh rupees. He converted such plot into stock in trade on 1st Feb 2023. Oh my god. Oh my god. Stamp duty value, that means, and on the conversion date it is FMV 60 lakh rupees. This plot was sold by E on 30th June 2025. This plot was sold by 30th June 2025 for 65 lakh rupees. Discuss the tax implication in the hands of A and E. CII is given to you. Just try to recall what we have studied. Sir, they both have parent subsidiary relationship? Yes. Are they 100% subsidiary? Yes. Recipient, if nothing is mentioned, we have to assume it is Indian only. Every condition is fulfilling. Every condition is fulfilling. Yes. So ideally there should be transfer, but transfer that would be exempt transfer. So whatever the transfer the A Limited has done is an exempt transfer. Whatever capital gain would arise, that would be exempt. Yes. But sir, there is a basic condition. There is a basic condition as to the recipient should continue to hold that asset for at least 8 years. Otherwise, 8 years as capital asset. If within 8 years, if recipient transfers it and converts into stock in trade, it shall become taxable. Since it has been converted, it shall become taxable, and it will be taxable in the hands of the transferor only, and it will be taxed in the year in which 2020 only. The year in which it is transferred, it would be taxed. And again, here indexation would apply. Indexation should apply. Indexation should apply because transfer took place previously now. Before 23rd July, transfer took place. Just let me show you the answer. Just have a look. It would be taxed in as a previous at 2021 only. Full value of consideration shall be 35 because this was the full value of consideration. Cost of acquisition shall be indexed because transfer took place before and this would be taxed. What was difficult in this? The fact that we didn't remember was the only issue. I can assure that you didn't remember this point. But this wasn't something that was very out of the box, to be honest. Exam pressure is something that is difficult to handle, which makes these questions difficult. I can accept that. But that does not mean that question paper was difficult. Okay. Now just think of from E Limited's point of view. E Limited's point of view. Now he has received a capital asset which is converted into stock in trade. Capital asset received on 1st October 2024. 2024, no, 2020. It is converted into stock in trade on 1st Feb 2023. And later on stock in trade is sold. Sir, for this company, for E Limited, capital gain would be fixed on this date. On 1st Feb 2023, capital gain would be fixed. Capital gain would be fixed. Same thing is mentioned here. Capital gain would be fixed. This capital gain would be fixed. But this would be taxed in the year in which this actual stock in trade is sold. This actual stock in trade is sold off for 65 lakh rupees on 30th June. So whatever the capital gain that was fixed on this date, on the date of conversion, that would be charged in the previous year in which stock in trade is sold. And of course, we would have some business income as well. Tell me, is it that difficult to digest? Is it that difficult to digest? I mean, when I saw the paper, now, to be honest, I don't want to say anything against. Of course, at the time of paper now, mindset of every student is different. Of course, we have some of our strengths, we have some of our weaknesses. The fact is now, when you analyze after coming from paper, or if you analyze 2 days, 3 days after paper, when you are relaxed, you will realize that paper wasn't that difficult. It wasn't our temperament. It was somewhere our issue that we lost our temperament. I think that happens. That really happens. So for that matter, it is okay. It is okay to blame for a day. It is okay to blame institute. It is okay to blame ICI. It is okay to blame your faculties for a day. But some introspection is required. The paper isn't difficult. We did not recall this at that point of time because of exam pressure. That was a bigger issue. For that matter, what can be done? Practice. Practice, practice, practice. The more you practice, the more you will be able to recall an exam. Got it? Transfer in case of amalgamation. Yes, sir. I'm not blaming actually. Pata, what happened? You know what? I'm just getting. I got emotional at that point of time. When paper came out, na, I came up with a review. I'm just telling you for 2 minutes. Paper came out. Paper was over at 5 p.m. and at 5:50, I came up with a review. I came up with exam review. And when I saw the paper, na, I didn't see the MCQ portion. And my habit is I never see the first question. I never see the first question. I see question number six. I saw question number six was okay. It felt easy. I came to question number five. It felt more easy because question number five, the assessment question that was asked in Jan 26, the same we had discussed because it was from judicial updates only. I felt again it was easy. I saw question number four, cost plus method, same question from our book. I saw TDS, absolutely similar figures matching from some sections that we have already discussed. When I saw trust taxation felt a bit uneasy one because calculations was involved. But when I tried to solve that question, that wasn't that difficult. We had done much difficult questions in Super 100. I saw question number 3B, DTAA. That was all simple. That means four questions I saw were easy. That made me think that paper is simpler. When I came to question number two, I saw this capital gain question. Because four questions I already knew now. Four questions I already knew. I think that I thought that four questions were easy. So I thought remaining two would be also easy. I saw the paper. I felt that capital gain was easy. At some point, I felt buyback was also easy. I saw the NR taxation question. I thought that it was difficult on the upper end because people are not able to recall NR taxation at time. But still, one question in paper, it was difficult. In PGBP, I saw entire questions, adjustments were similar, but they had asked tax rate as well. They had asked 115 BAA as well. I I made a conclusion that paper is lengthy because whenever they ask na tax in PGBP, whenever they ask tax rates in first question, na paper becomes lengthy. It is default that paper would become lengthy, and people have a habit of writing too much in exam. When you know something, na you write too much in exam, so you would feel paper lengthy only. When I made this opinion that paper was not difficult. Paper was not difficult but lengthy. You don't know how much criticism I got. How much criticism I got. How much criticism I could not sleep that night. I was not open to that much criticism at that point of time. I think I was sharing my honest opinion, but on that day I had too much of criticism from outside. But the thing is now I was honest, and later on everybody realized that paper wasn't difficult. When they saw IDT, na, they felt like, "Arey sir, DT was easy." All of a sudden, who were thinking, so DT was difficult, how can you say this, it was easy, you solve yourself and let us show that you did in 3 hours, how can you cannot even, people even said that you cannot solve that paper in 3 hours, people also alleged that, people also said that. Okay, people also said that you will not be able to do that paper in 3 hours. But when those same students saw the IDT paper, they felt like, sir, you did well, DT was better, DT was better, the IDT was nightmare. Those same people, when they saw IBS, they felt like IDT was easier. What am I trying to tell you is, paper is not difficult always. What paper is not difficult always, okay? Sometimes examiner tries to trick us, okay? The examiner tries to trick us. This was beautifully done in DT. Of course, IDT was difficult. Examiner didn't trick in IDT. IDT paper was difficult. IBS paper was difficult. But DT, I can surely say that it wasn't difficult. If you see my MCQ video, I posted MCQ video. And I put that video down in 1 hour. In 1 hour only, I had 5,000 views on that MCQ video. 1 hour only, 5,000 students viewed that. And I had 100 comments in that video, and 100 comments were negative. And today, when I checked the suggested answer, 28 MCQs were correct. One MCQ was wrong, and that I corrected only. As soon as I posted video, in comment section only, I posted that one MCQ I have done wrong. I have corrected that. Immediately, I realized one MCQ I did wrong. 30 out of 30 MCQs were correct in MCQ video. But 100 bad comments I received, just because students had exam anxiety, exam fear, so they targeted on that video. I'm not saying anything against me, that it can happen to anybody. It can happen to anybody who posts such videos, such controversial videos. MCQs is very controversial. I might think the MCQ answer is A, somebody thinks MCQ's answer B, somebody might disagree with me. But what I'm trying to say is, now, papers are not difficult. DT paper wasn't difficult in Jan 26. It was just a brain play. It was a brain play with students where students fail to understand ICI's game trick. You must be able to analyze which question to solve and which question not to solve. If you would have attempted question number 5 and not question number 2, I can say that 5 to 7 marks increment would have been there. For sure, 5 to 7 marks, because what was asked in question number 5 was very easy. Question number 2 was difficult. So always keep in mind, if you are my student, it's my moral duty to prepare yourself for the worst. For the worst, you should be prepared. You should be prepared to tackle out the difficult situations, find out the easier ones, not a find out a way to blame somebody. Okay? Now, come on to exempt transfer. What these exempt transfer imply? Monica says mandatory question done because of your super 100 questions of PGP. It means a lot to me, Monica. It means a lot to me. Sir, exempt transfer we are discussing. In this list of exempt transfer, we have amalgamation. Sir, what is an amalgamation? Remember, under Income Tax Act, for example, if there is X Limited, merges X Limited and Y Limited, becomes Z Limited. It is called amalgamation. Yes, under Income Tax it is amalgamation. X Limited plus Y Limited, if it becomes X Limited, you might call it acquisition, but it is amalgamation in income tax. X Limited plus Y Limited becomes Y Limited. In income tax, it is also called amalgamation. X Limited plus Y Limited becomes XY Limited. Under accounts, you might say it as joint venture, but again, it is amalgamation. Whatever acquisition, joint venture, amalgamation, merger, whatever you say in accounts, it is amalgamation here only. Provision says if two or more companies merge to form a single company, where all the assets and liabilities of the amalgamating companies become assets and liabilities of amalgamated company. Plus, shareholders holding minimum 75% of the shares of the amalgamating company become shareholders of amalgamated company. What does that mean? For example, the classic example is Blinkit. Blinkit amalgamated with Zomato. Now, whatever the dark stores this Blinkit had, whatever the franchises, whatever the things that this Blinkit had, this Blinkit's assets became assets of the Zomato. So this is a valid amalgamation. Second thing, whoever the shareholders of Blinkit were, at least a 75% of such shareholders shall become shareholders in Zomato as well. It would be considered as exempt transfer. It would be considered as valid amalgamation. At least 75% of the shareholders of Blinkit shall become shareholders in Zomato. Now, if it is a valid amalgamation, there are 4 transfers that are going to be exempt transfer. For 4 transfers. What are those 4 transfers? Listen carefully. For example, Blinkit has certain assets. Blinkit had assets and Blinkit amalgamated with Zomato. Now his dark stores would go to Zomato. His franchisees would go to Zomato. His patents would go to Zomato. His other assets like inventory, like other assets would also go to Zomato. So there is transfer happening now. Transfer of capital assets from Blinkit to Zomato. It is happening. Provision says it is an exempt transfer. If any capital asset are being transferred from Blinkit to Zomato, it is an exempt transfer. Second thing, just imagine it. Shareholder of Blinkit is Rahul. Assume shareholder of Blinkit is Rahul. Why to assume? I am only the shareholder of Blinkit. Now, if I am the shareholder of Blinkit and all of a sudden my shares are taken away, my shares in Blinkit are taken away for no reason, they have been taken away, and forcefully I got shares of Zomato. I have shares of Blinkit and forcefully, without my choice, they have been taken away and given the shares of Zomato. Provision says that is an exempt transfer. What provision says? Surrender of shares by the shareholders. Surrender of shares by the shareholders of amalgamating company for receiving the shares of amalgamated company. Rahul surrendering the shares of Blinkit to get the shares of Zomato. It is an exempt transfer. Third point. This is important. This is crucial. For example, as of now, if you are aware, Jio's 10% shares have been held by Facebook. 10% shares are held by Facebook. I mean, Jio in Jio, 10% investment is made by Facebook. Facebook of US. One day, Facebook decided that it don't want to continue. It amalgamated itself with Meta. Is it possible? Kya? Yes, they might amalgamate. Of course, it is a subsidiary. Facebook is a subsidiary of Meta only. But Facebook was serving alone. Later on, it amalgamated with Meta now. Provision says ultimately the shares of Jio are being transferred, if you can see. Ultimately, shares of Jio are being transferred. Earlier, shares were held by Facebook. Now they are held by Meta. Provision says if transfer of shares of the Indian company or foreign company, in case of amalgamation between the foreign companies, if there are two foreign companies being amalgamated, and in that amalgamation, shares of Indian company are being transferred. It is possible now that shares are held by this foreign company and amalgamated with other foreign company. Indian company shares are being transferred. Provision says that shall be exempt transfer provided at least 25% of the shareholders continue. That means at least 100 out of 100 shareholders, 25 shall continue with Meta. That shall be the case. That is not relevant. But understand, two foreign companies amalgamating, any transfer of shares would be exempt transfer. At last, transfer of capital assets in case of banking company with banking institution. If a banking company amalgamates with banking institution. If you remember, there was amalgamation case few years back. Vijaya Bank plus Corporation Bank plus Union Bank became Union Bank. So whatever the properties, whatever the assets of this Vijaya Bank were, whatever the ATMs of this Vijaya Bank or Corporation Bank was, were transferred to Union Bank. In this case, what happened? In this case, sir, it was an exempt transfer. It is considered as exempt transfer. Okay, sir. Okay. This is about amalgamation. Transfer under demerger. Transfer under demerger. It is also a good point. Beautiful point. What is a demerger, sir? What is a demerger? Definition is good. Let's understand this with an example. For example, we have Reliance, and out of this Reliance, a small company originates, which is Jio Financial Services. In this case, Reliance is called demerged company, and Jio Financial Services is called resulting company. Reliance had net assets of 1000 crore, and out of this 100 crore have been taken away by Jio. 100 crore have been taken away by the Jio. For example, land is taken by Jio, customer base is taken by Jio, inventory, cash, whatever extra 10%, but the 10% assets have been taken away by Jio. When it is considered as a valid demerger under income tax provision, clearly demonstrates all assets and liabilities of undertaking transferred by the demerged company shall become assets and liabilities of the resulting company. That means whenever Reliance releases 100 crore of assets, now these assets should come to Jio. These assets are not sold to an outsider or not to a shareholder. Whatever assets and liabilities are given by Reliance should become assets and liabilities of Jio only. It should not go to outsider. Oh. Whenever Jio receives these 100 crore of assets, now Jio shall receive record these assets at book value. Remember, when resulting company is receiving assets from the parent or from the demerged company, now it should record these assets at book value only. No revaluation should be done. No revaluation should be done. But sir, what if this company follows Ind AS? What if this resulting company follows Ind AS? In Ind AS, we have to record shares at fair market value. If you remember FR, whenever there is a demerger happening, the resulting company has to record shares at has to record assets at fair market value or not at book value, of course. What would happen? Provision says yes, it's okay. If in compliance of Ind AS you have to record at any other value, that's okay. But otherwise, you cannot record at any other value other than book value. That means in case of demerger, if you receive any assets, it should be recorded at book value only. But in compliance of Ind AS, we are okay. Higher value can be okay in compliance with Ind AS. Oh wow. Listen, huh? Resulting company issues its shares to the shareholders of the demerged company on the proportion except on the basis of resulting company itself as the holder of the demerged company. Oh. What this point says, listen up. Reliance is giving away its 100 crore of assets to Jio. What Reliance is getting in return? What Reliance is getting? Sir, it should get only the shares of this company, nothing else. If Reliance is giving up its 100 crore of assets, it should get share capital of the Jio Financial Services and nothing else. Nothing else. Only share capital. Oh. 75% of the shareholders shall become shareholders in resulting company. For example, if somebody has there are 100 shareholders in Reliance, provision says at least 75% of the shareholders shall become shareholders in Jio as well. And at last, the transfer shall be on going concern basis. That means a running business should be transferred. A running business should be transferred, not a dead business, not a closed business should be transferred. If all the 5 conditions are met, it is a valid demerger. It is a valid demerger. Now, what happens in case of valid demerger? There are 3 transactions that are exempt transfer. For example, Reliance is giving up its 100 crore of assets, 100 crore of assets to Jio Financial Services. So ultimately, assets are being transferred now. So it is an exempt transfer. Any asset transferred on account of demerger from demerged company to resulting company, it is an exempt transfer. Second point, another important point. Huh? For example, Rahul held 1 share of Reliance and value was 1500. Out of this, Reliance Jio Financial Services demerged. And share price of Jio Financial Services is 150. Reliance of share of Reliance broke up to 1350 because, of course, in case of demerger, assets are transferred, so share price would also fall. If you remember the definition of the transfer, we had parting of an asset is also a transfer. If asset is being parted off, now it is considered as transfer. If asset has been partitioned, it is a transfer. Because ultimately 10% of the net assets, 10% of the assets are being lost now. If I hold any asset and I lose 10% of the value, I lose the 10% of the value in the partition. Ultimately, it is a transfer. Provision says no, it is an exempt transfer. Whatever the partition takes place at the time of demerger, your 10% assets are lost. You receive new shares, it is an exempt transfer. Everything is an exempt transfer. Last example for demerger. It is also important to understand. For example, Jio. As of now, 10% of the shares of the Jio are held by Meta. 10% of the shares of the Jio are held by Meta. And out of this Meta, a company demerges called Facebook. And in case of demerger, the assets of Jio are transferred from Meta to Facebook. It has happened now. The example we discussed, Jio was there, Jio amalgamated with Meta. So there was transfer, exempt transfer. We discussed 2 minutes, 5 minutes back. Same transfer. Now Meta is having shares and Jio is demerging, Facebook is demerging from Meta. In this case, transfer is happening. Ultimately, shares were held by Meta. Now they are being held by the Facebook. There is again transfer happening. Provision says it is also exempt transfer. Transfer of shares of Indian company. In case of demerger between the foreign companies, it is an exempt transfer. Got it? Got it, sir. Sir. Sir, we got that point. We got that point. This is about amalgamation and demerger. Amalgamation and demerger. Very simple points these were. Redemption of sovereign gold bond by individual SSC. I mean, this is very controversial. You know what are sovereign gold bonds? You know what are sovereign gold bonds? See, it is the matter of, 6 to 7 years back. Government of India came up with a concept called sovereign gold bonds. Now, people used to invest in gold to get the capital appreciation. They used to buy the gold and keep it in their locker just to get the capital appreciation. Now, government had to import most of the gold to fulfill the basic needs of the India. Okay. So what they did, they issued sovereign gold bonds. Now, what are the sovereign gold bonds? See, for example, if gold is traded at 15,000 rupees per gram, this bond would be traded at 100 rupees lesser. You can buy this bond at 100 rupees lesser. That means 14,900. You can buy this bond. The way gold will appreciate now is the same way this bond will appreciate. Along with that, you will be given interest of 2.5%. Along with that, if you are an individual who buys the sovereign gold bond and holds till maturity, now, you will not be charged any capital gain as well. So this was a beneficial win-win situation. But government issued the sovereign gold bonds for 3,000 rupees, 4,000 rupees, and today gold price is 17,000 rupees per gram. They had to pay 5 times in just 5 years. 5 to 6 years, they had to pay 5 times. Government discontinued scheme poorly. They discontinued this scheme. But of course, since this scheme, of course, gold bonds are still into existence. So we need to understand, if you are an individual who hold sovereign gold bond till maturity, it is exempt transfer. But if you transfer before maturity, it is capital gain applicable. So capital gain would be absolutely applicable. Any other SSC, for example, any HUF, any company, any AOP, BOI partnership firm, they are transferring even at the time of maturity or before maturity, it is taxable. For every other SSC, it is taxable, but for an individual who holds till maturity, it is exempt. And any interest on sovereign gold bond, it is always taxable. Done, sir, done, sir, done, sir. For example, listen to this very practical life scenario. Very practical life scenario. For example, I am 70 years old, Rahul. I cannot even walk. I barely walk with a stick. I barely walk with a stick. You must be wondering, overacting started. You must be wondering, I know. I have this house, only house. I have 6 children. Somebody settled in USA, somebody in UK, the other in Switzerland, the other in Germany, the other in Spain, the other in Italy, the other in France. Sorry, 7 children I have. 7 children I have. Everybody settled outside. They barely call me. They barely ask me to come there. They have been completely cut off. Today I have a house. And I know all these Nalayak children should not deserve this house. They have their own properties in their respective countries. They don't require any property. But I require money. No? I am 70 years old. I am 70 years old. I live on a stick. I want money. I want money on regular basis. I don't have money. What did I do? I went to bank. I went to bank. I said, bank. Can you help me out? Bank said, of course. What happened, sir? I said, bank, listen, I have this house, but I have no money. Can you give me money? Bank said, of course, sell this house. No. I want to stay in this house. I want to stay in this house. I am saying to bank. Bank says, okay, we will do a reverse mortgage scheme. What will happen? Every month I will pay you 70,000 rupees for 12 months for till the time you are alive. Till the time you are 70, you might be living till 80, you might be living till 90, you might be living till 100, you might be living till 120, whatever the cases, we will pay you. So 8,40,000 rupees we would pay you every year till the time you are alive. Once you die, this house will become ours. Once you die, this house becomes ours. What a beautiful scheme. What if I stayed? What if I was alive till 150 years of age? Wow. I was alive till 150 years of age. So bank has to pay me 840 into 50, 70 years, 80 years. Whatever the money they are required to pay, they will pay that. What's the issue? Provision says this is a reverse mortgage scheme. In mortgage scheme, what happens is house is with you and you pay to bank. Here, house is with you only, but bank pays you. This is the reverse mortgage scheme. Bank pays you. Provision says any transfer. See, you are ultimately handing over the possession to the bank, so it is an exempt transfer. Whatever money you are receiving, that is also exempt transfer. Whatever money you are receiving is absolutely exempt. Okay. My question to all of you is, what if bank sells this house? What if bank sells this house? For example, at 1 crore rupees, what will be the cost of acquisition for bank? Oh, oh. Sir, what will be the cost of acquisition for the bank? You have three options. Cost of acquisition of mine would become cost of acquisition of the bank. This is the first case. Second thing, zero cost of acquisition for the bank. Third case, whatever the money that bank has paid to me, that will become cost of acquisition. What will be the correct answer? What will be the correct answer? Zero would be cost of acquisition. Money paid to me will be cost of acquisition, or whatever the purchase price of Rahul is would become cost of acquisition. What will become? Sir, we were aware about the provision, but you always throw a bouncer. So what? Why did I take these much examples? I know to elevate your level, to think, to ask you to think more. What will be the cost of acquisition? Ji, beautiful, beautiful, Diya, beautiful, Satish. Right answer is money paid. See, it is an exempt transfer for Rahul. It is an exempt transfer for Rahul. But bank is paying some money to acquire the asset now. So cost of acquisition of the previous owner shall not be taken in this case. Okay? Cost of acquisition of the previous owner shall not be taken. Rather money paid shall be taken because bank has paid some money to acquire the asset now. Bank has paid some money now to acquire the asset. So price paid to Rahul would be cost of acquisition. Cost of acquisition of the Rahul would not be given to bank. Okay, sir. Okay, sir. Okay. Done, sir. Done, sir. Now, sir, sometimes what happens, I transfer my assets under stock lending scheme. Are you aware of stock lending scheme? This happens in AFM also. You must have studied this. See, if I want shares right now, but I don't have it, I don't have them. I want to sell the shares, but I don't have any shares. How can I sell? I can do short selling. But short selling is not valid. It is only valid on intraday basis. So I can borrow shares from somebody. Sell it out, buy it again, and return to the lender. It is allowed. In the market, it is allowed. I can borrow shares from somebody. Now, if I borrowed shares from somebody and I'm selling that, I have right to sell that assets. I became the beneficiary owner of the shares. So shouldn't the transfer under lending scheme be transfer in the hands of the lender? The person who is giving away his shares shouldn't be transferred in his hand. Provision says no. Under stock lending scheme, any transfer of shares is an exempt transfer. Don't need to think about it much. Any transfer of shares under stock lending scheme is an exempt transfer. Now listen to this point very carefully. One day, I was painting. I was painting. Just by mistake, I drew this. I drew this. And I drew this. And I drew this. No, not this, but this. Can you see the solitude in her face? Can you see solitude in her face? The beauty, the charm, the solitude. I framed her and I named her Sona Lisa. You know Mona Lisa? You know Mona Lisa? Mona Lisa? The world famous painting made by Leonardo da Vinci. You are aware? Same painting I drew named Sona Lisa. Bhai Sahab, people of India went crazy to watch this painting. People of India went crazy to watch this painting. Entire Instagram is flooded with Sona Lisa. The solitude she brings on her face is better than Mona Lisa. There are copies being circulated in the market, but I am the owner. You know what? Ambani ji came to me asking, giving 100 crore rupees, giving 100 crore rupees, just because he wanted to buy the souvenir. Adani ji also came. He said he will offer me 150 crore rupees. Mittal Saab came with 120 crore rupees. Even Amit Shah sir came. Amit Shah ji came asking for 80 crore rupees of this painting for this painting. I thought this is so valuable. Oh wow, a piece of art so valuable. Instead of giving this property to anybody, I transferred this property to a national museum at Delhi. At National Museum at Delhi, I transferred this property at National Museum. I thought, why should I have all the fun? Why should I have all the fun? Why shouldn't the people of India watch it? The live example of beauty, the solitude, the charm, such heights of over. I transferred it to National Museum for just 2 lakh rupees. It is worth 100 crores. But I transferred it to National Museum. Provision says any capital gain arising on this account shall be exempt to transfer. This shall be exempt to transfer. Transfer of any work of art, archaeological collection, manuscript, photograph, book, print to a government, university, national museum, any art gallery, or any archives. If you transfer any asset, it is an exempt transfer. So you could have simply stated that point. You could have simply stated that if you transfer any painting, it is an exempt transfer. Why did you intended to take this example? Arey Baba, you have to enjoy this class as well. We are not studying for 85 hours. If we just study, you will not. We will reduce by 10 hours. Our content would reduce by 10 hours. But you will not enjoy the batch. Enjoyment has to be there, no? You can hold this point for some time. Transfer of business trust asset, transfer of business, you can hold for some time. When we will be doing business trust, now we'll understand this point. See, if you are a predecessor cooperative bank and you transfer assets to successor cooperative bank, it is an exempt transfer. If you are an infra financing company and you transfer your assets, you amalgamate with any institution which is meant for finance, it is also exempt transfer. If public sector companies transfers capital asset to any other public sector company where scheme has been approved by the central government, it is also exempt transfer. This point you can skip out, sir. Mutual fund related exempt transfer. Mutual fund are subject to market risks. Read all schemes related documents carefully. What are these mutual funds? See, first of all, now what this says, if any two mutual funds amalgamate. Sir, for example, if there is an equity oriented mutual funds amalgamated with equity oriented mutual fund, it is an exempt transfer. If any debt oriented mutual fund amalgamates any debt oriented mutual fund, it is an exempt transfer. But what if equity oriented mutual fund amalgamates with debt oriented mutual fund? It is a taxable transfer. Carefully, always understand two equity oriented would be exempt, two debt oriented would be exempt, but cross merger would always be taxable transfer. Now, how these impact, understand now, how these transfer impact, listen very carefully. For example, Rahul is there. Rahul has 100 units of NAV, say 1000 of Nippon India Classic Fund. Nippon also holds another fund, Nippon India Wealth Fund. These are two mutual funds. These are two mutual funds by the same company, Nippon. I have Nippon India Classic Fund, and there is also a fund existing, Nippon India Wealth Fund. All of a sudden, out of nowhere, Nippon India felt like we don't want to continue different funds. They merged these two funds. They merged these two funds. Can two mutual funds be merged? Yes, they can be merged. If there are two schemes going on, they can be merged. At any point of time, they can be merged. See, I was snatched. I had 100 units of Nippon India Classic Fund. I was snatched and I was given 150 units of Nippon India Growth Fund. Both the two funds were amalgamated and new fund was created, that is Nippon India Growth Fund. And I was given 150 units whose NAV was 90. Oh dear God. Oh dear God. Can I say earlier I had assets of 1 lakh rupees. Now these assets are 135 lakh rupees. Sorry, 1.35 lakh rupees. Can I say, sir, how come there is increase in value? How come there is increase in value? Are Baba, synergy benefits. You mergers. Forgot AFM. When two things merge, they have synergy benefits, value increases, value unlocking happens. It happens now. So synergy benefit gave me benefit. Provision says any increment, any benefit on account of amalgamation between two equity-oriented mutual fund, that is an exempt transfer, no capital gain would be arising in this case. Similarly, if two debt-oriented mutual fund amalgamate with each other, they are also considered as exempt transfer. No capital gain would arise in this case as well. Oh wow, sir. Oh wow. Oh wow. Sometimes what happens, for example, Rahul has Nippon India dividend plan, dividend plan. And all of a sudden, this dividend plan is switched to Nippon India reinvestment plan. Earlier, dividend was paid out to me. Right now, dividend is not paid out, dividend is reinvested. So, plan is being changed. Provision says if there is any change in plan, if there is any change in plan, any transfer, any benefit is an exempt transfer. Any benefit is an exempt transfer. Got it, G? Very simple point. Got it? Got it, G. Got it. Got it, G. Got it. Yes, sir. We got it. In case of mutual fund, if two mutual fund plans, if two mutual funds are amalgamated now, if they both are equity oriented or if they both are debt oriented, any gain arising would be exempt transfer. But if there is cross amalgamation, it will be taxable transfer. If there are two mutual fund plans being consolidated, it is also exempt transfer. Done, sir. Done, sir. Done, sir. Done, done, and done, sir. Now we can take break. Of course, we are left with certain exempt transfers, but I want to give this point at some time because exempt transfer, I don't know when can be asked. ICI knows that we shouldn't skip out the exempt transfer. Therefore, I would give exempt transfer some more time. It is 9:30. I give you break till 9:50 plus minus 2 minutes. Plus minus 2 minutes. Okay. Have breakfast. Do not use phone and see you guys after the break. Important topic coming up after break. Do not skip out. Anji, welcome back. Are you all back from break? Yes. So now there is no issue now with that synchronization. I mean, the way my voice was not synchronizing with my action. Is it settled now? Yes, sir. Now, we were studying the exempt transfer. The transfer which appear to be transfer but exempt in the eyes of income tax. In that series, continuing further, that is conversion of entities. Sir, when a sole proprietor converts itself to a company, provision says there is a lot of assets transferring. Still the same? Still it is not synchronizing. Oh dear God. Can you wait for a minute? Can you wait for a minute? Is it getting normal? My audio video is synchronizing. But I thought that it got settled. I was really unaware that it is not syncing. I thought it got settled. Oh, baapre. How do I fix that? I'm really not aware. Acha, is it that issue? I mean, able to understand things? So we will not be able to solve questions if that continues. Honestly, we will not be able to solve questions. Your voice is first, then your actions. Baapre. Hello, we'll go slow. We'll go slow. Yeah, I wanted to solve the questions today. I don't think that we'll be able to do that. Manageable, sir, that is not the problem. See, that is a good gesture, Satish, that it is manageable. But the fact is, somebody who is watching the recorded lectures now might not manage. I mean, if there are 100 students, at least five will raise this issue that it is not manageable. I was thinking that it got settled. No issue, no issue, no issue, no issue. Okay, we'll go slow so that it is not an issue for you all. Okay, we'll go slow. Sir, we were discussing the exempt transfer in that series. We continued. Sir, if a sole proprietor converts itself to a company, can he do so? Of course he can do. Of course he can do. It is absolutely allowed. Sir, if he converts into company, assets are being transferred to the company. In return, he gets shares of the company. There are multiple transfers happening now, so it shall become exempt transfer provided following conditions are fulfilled. What conditions are fulfilled? First of all assets, liabilities of the proprietor shall go to company. All the assets that a proprietor has should go to company. And in return, he should only get shares. In return, he should not get any cash. In return, he should only get shares of the company. Remember, he shall become the only shareholder in the company. And in addition to that, sir, listen very carefully. This is an issue. This is an important point. Since he is the 100% shareholder, he is the 100% shareholder. Provision says he should continue to hold these 100% shareholders, or at least minimum 51% shares he should be holding to 5 years from date of conversion. From date of conversion. The date on which conversion took place, now from that date till the fifth year end, he should hold at least 51% of the shares. Why, sir? Why 51%? Sorry, 50% shares from the 5 years. So at least he should hold 50%. He should hold 50% of the shares till the 5 years from the date of conversion. That means he can sell some shares. Once he converts into company, he can sell some shares. He can continue selling those shares, but he should hold at least 50%. At least 50% he should be holding. Okay. So three conditions attached to a proprietor. All the assets should go to company, he should become shareholders, and he should hold minimum 50% of the shares in the company till the 5 years. Got it, sir? Got it. Similar provisions if a partnership converts into a company. If a partnership firm converts into a company, again the provision remains same. All the assets shall become all the assets and liabilities shall become assets and liabilities of the company. Partners are allotted share capital and no cash in return. Consideration to the partners is only the share capital. And share capital ratio should be on the basis of outstanding share capital. Whatever their partners' capital was there, in that ratio, share capital should be allotted. Remember, those who were the partners, A, B, C partners, they are allotted 100% shares in the company. These partners shall continue to hold 50% of the shares till 5 years from date of conversion. These partners shall continue to hold 50%. If they hold less than 50%, so again it will be a violation. What will happen in case of violation? We will discuss that. Sir, these two are exempt transfer. If all the conditions are satisfied now, whatever the transfer of asset take place between the two, it is an exempt transfer. What if unlisted public company converts itself into LLP? Unlisted public company converts into LLP. Public company converting to LLP. Oh, can a public company convert into LLP? Yes, it can convert, but provided certain conditions are fulfilled. Whichever company wants to convert itself into LLP, now remember, from the date of conversion in preceding three previous year, their turnover should not be more than 60 lakh rupees. It should be less than 60 lakh rupees. Whichever company wants to convert itself into LLP, its turnover should not be more than 60 lakh rupees. And total asset owned by such company should be up to 5 crore only, not more than 5 crore at all. Whichever company wants to convert itself into LLP, its turnover should be up to 60 lakh, and your total assets in last 3 years at any point of time should not be more than 5 crore. If both the conditions are satisfied, you can clearly convert yourself into LLP. What are the conditions attached? Carefully listen. If company is converting into LLP, all the assets and liabilities of the company should go to LLP. All the shareholders shall become partners. All the shareholders shall become partners in the firm. Shareholders shall become partners, and their capital contribution and profit sharing ratio are in the proportion of their shareholding. That means if this shareholder was 20% shareholder, then his capital contribution in the part LLP should be 20% only, and his profit sharing ratio should be 20% only. Oh, sir, if company is transferring all the assets to the LLP, what shareholders would be getting? Sir, shareholders would get nothing. Shareholders would get nothing, but only in capital share and profit. That means if all the assets of the company are being transferred to LLP, now shareholders would get only the share profit sharing ratio. They would only get the profit sharing ratio, nothing else. Sir, if a company converts into LLP, for example, there are 4 shareholders A, B, C, D. They shall become partners. They shall become partners in the ratio of their share capital. Yes. Provision says they shall continue to hold these all the partners, those who are partners at the time of company, they shall continue to hold 50% in profits, 50% share in profits up to 5 years from date of conversion. From the date of conversion up to 5 years, they shall continue to hold 50% profits. Okay. What if they violate? We'll discuss that. What if they violate? We will discuss that. Last condition. Sir, what's the last condition? Listen carefully. See, if a company is converting into LLP, I'm telling you an example. If there was a company whose balance sheet looked like this: share capital 1 crore, reserves and surplus 3 crore, all the assets 4 crore. Can this company convert into LLP? Yes, sir, it can convert because it has assets up to 5 crore only. Assets up to 5 crore only. But if you are aware that whenever somebody wants to distribute this reserves and surplus, whenever any company wants to distribute these reserves and surplus, it can only do so via distributing dividend. It can only do so via distributing dividend. A company can distribute its reserve only via dividend. And if it distributes dividend, it is taxable in the hands of the shareholders. Yes. We will study that in IFOS as well. It is taxable under that IFOS. My question to all of you: can I convert this company into LLP? Now, once this company is converted into LLP, this reserves and surplus would be open. This reserves and surplus would be free. I can distribute because in LLP there is no such concept of reserves and surplus. Everything that is there, that is of partners only. Partners can take away any reserves without paying any taxes. Wow, sir, such a loophole drawn. Beautiful loophole drawn. That if you want to take out reserves from a company, you can convert into LLP. Beautiful, beautiful, beautiful. No amount shall be paid directly, indirectly to the partners from the accumulated reserves standing on the date of the conversion up to 3 years from the date of the conversion. On the date of conversion, whatever the balance is there, now whatever the balance is there of the reserves and surplus, that should not be distributed to partners up to 3 years. Wow, sir. Wow, wow, wow. So what did I say? Try speaking after me. This is an important. These are important conditions. Try speaking after me. Proprietor wanting to convert into company, all the assets should go to company. Proprietor shall get only the share capital, and he shall be the only shareholder. Second, firm wants to convert into company, all the assets should go to company. The partners should get the share in the company in the ratio of their capital contribution. And these partners shall continue to hold at least 50% of the shares up to 5 years from the date of conversion. If company wants to convert into LLP, first of all, company's turnover in preceding 3 years should be maximum 60 lakh rupees in any year. The company which wants to convert shall have assets up to 5 crore only in any of the 3 previous years at any point of time in the 3 years. In addition to that, sir, all the assets of the company should go to LLP. All the all the shareholders shall get share in profit and shall get share in contribution, capital contribution. These these shareholders who become the partners shall continue to hold at least 50% of the profits till the 5 years from the date of conversion. And at last, once conversion take place, now, whatever the reserves were there on the conversion date, that shall not be distributed to the partners up to 5 years. Up to 5 years, it should not be distributed. What if, sir, violation done? What if violation done, sir? If violation is done by any of the entity, now in that case, the successor entity, the newly formed entity, will have to face the repercussions. In that case, it would be taxable in the hands of the successive entity. That means, for example, if proprietor converts into company and he does not hold shares up to 50%, he sold majority of his shares, then company has to bear the taxes, and taxes will be borne in the year of violation. See, there is a difference. Taxes will be charged in the year of violation. That means if violation took place in previous at 25-26, then taxes would be charged in previous at 25-26 only. Similarly, if company converts into LLP, and LLP violates, partners sell off their shares, sell off their profit sharing ratio to somebody else. In this case, now LLP will have to base the repercussions in the year of violation. But if you remember, in case of parent company transferring assets to subsidiary, and for example, subsidiary converting such into stock in trade, again, this was also taxable, but this was taxable in the year in which transfer took place. There are differences between the two. In this case, transfer taxability arises in the year in which transfer took place. In this case, transfer year is important. But in case of conversion, violation year is important. I hope you got the point. Conversion of securities. See, if you have debentures of a company, bonds of a company, debenture stocks of a company, and these are converted into shares of the same company, it is an exempt transfer. It is an absolutely exempt transfer. Sir, if you have preference shares of a company and they are converted into equity shares of the company, that is also exempt transfer. If you have physical gold and you convert it into the digital gold, it is also exempt transfer. Capital gain in case of non-resident, you have to hold for some time. We will do this when we will study non-resident taxation. We will discuss this in more depth. You don't worry about it. You will be able to understand everything once we are done with NR taxation. Now, I want your attention for at least next 5 minutes. Next 5 minutes, Naji, your attention is important. Your attention is important. For example, I'm telling you a case. I'm telling you a case. For example, we have with us Miss Jayashree. Miss Jayashree had a house acquired on 1st April 2001 for 15 lakh. She constructed a balcony, 10 lakh. On 1st April 2006. 1st October 2010 was the historic date on which she gifted the house to her son. Son, uh, on 1st April 2016, did renovation for 25 lakh. No, 25 lakh, nahi, 35 lakh. 1st April 2025, son sold the house for 2 crore and bought bonds of NHAI worth 50 lakh. This is applicable to all the exempt transfers. All the exempt transfers. I want you all to practice this question as well. In addition to that, try understand the provision as well. My question to all of you. Capital gain will be computed. Capital gain will be computed in the hands of the son of Jeshri. Capital gain in hands of Jeshri's son. Previous year would be, of course, the year in which transfer took place, that is 25-26. Assessment year 26-27. Full value of consideration. Sir, full value of consideration, I am only telling 2 crore. Any transfer expenses? Nothing. Nothing, Ji, nothing, Ji, nothing. Net consideration would be 2 crore. Cost of acquisition. Here comes the twist. What will be the cost of acquisition for Jayashree's son? What will be the cost of acquisition for Jayashree's son? Sir, what the foolish question you are asking? You have told this multiple number of times that whenever you acquire any asset on account of exempt transfer, cost of acquisition of the previous owner is taken. You have already told us. What are you asking? Okay. Cost of acquisition, I'll be taking 15. 15? Yes, 15 lakh. Can I write it down? Cost of acquisition of previous owner. Cost of acquisition of the previous owner shall be taken. Very simple point. In case of every exempt transfer, every exempt transfer, cost of acquisition of the previous owner shall be taken, or cost of acquisition before exempt transfer is taken. At the time of exempt transfer, na, you have to ignore everything. You have to take the cost before such exempt transfer. Okay, sir. Cost of improvement, how much shall be taken? Can you all help me out with the cost of improvement? Can you all help me out with cost of improvement? Can you all help me out? If you are good students, you will help me out. What will be the cost of improvement in this case? What will be the cost of improvement? See, 15 lakh is the cost of acquisition. She constructed the gallery, she constructed the balcony for 10 lakh rupees, and her son constructed the balcony or renovated the house for 35 lakh rupees. Can I say renovation done by son shall be renovation as well? Renovation done by the previous owner shall also be the improvement. For the purpose of improvement, both the things are to be added. Improvement done by the owner and improvement done by before owner before such exempt transfer. Improvement done by myself and improvement done before exempt transfer by the previous owner shall also be taken. That means, can I say 45 lakh? 45 lakh shall be taken. Wow, sir. Wow. Wow. Very good. Very good. Very good. That means, can I say capital gain will be nearly 200 minus 60, that is 140 lakh is the capital gain. 140 will be capital gain. Done, sir. How do I determine whether it is long-term capital gain or not? My question to all of you is, should I take period of holding from 2010 to 2025? Or should I be taking period of holding from 1 to 2025? What shall be the period of holding to determine whether it is long-term or short-term? What period of holding shall be taken from for determining period of holding? What period shall be taken? From the exempt transfer or before from the original period we shall be taking? From the original owner. What shall be the period of holding? Beautiful, beautiful, Satish. Sir, period of holding shall be 2001 to 2025. That means it will be long-term capital gain. Period of holding of previous owner as per case law or 1000. No, it will be old owner only. That means three things I understood till now. If there is an exempt transfer, then cost of acquisition shall be determined based on previous owner's cost of acquisition. Cost of improvement shall be taken of our improvement as well and previous owner's improvement as well. Period of holding shall comprise our period of holding as well as previous owner's period of holding as well. Yes. Yes, 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 yes. Yes, sir. Now, since Section 54 EC exemption is also there, Section 54 EC exemption is there, 50 lakh rupees, yes. This will give you long-term capital gain of 90 lakh rupees. Now, there implies tax calculation. There implies tax calculation. Now, question arises. First option, either pay 12.5% on 20, either pay 12.5% on 90 lakh. This is the first option. This is the first and the easiest option. 11.25 lakh. Or pay 20% with indexation. Is it a valid option? Yes, sir, we have a valid option. Now, see, Jayashree's son is an individual. He is selling in the immovable property, selling immovable property after 23rd July, acquired before 23rd July. Everything is consistent in this case. So therefore, he would have an option to pay 20% taxes also with indexation. Now, for the purpose of indexation, we have to solve this entire question. Again, with indexation, we have to solve this question. How we are going to solve it? Sir, full value of consideration again shall be 2 crore. Cost of acquisition shall be 15 lakh rupees. But sir, cost of acquisition shall be indexed. Listen, Baba, listen. Listen, Baba, listen. Sir, cost of acquisition shall be indexed. It shall be indexed up to 376. But sir, till from when we are going to index? We are going to index from this owner, or indexation shall be done from this old owner. From where indexation will be done? This cost of 15 lakh rupees shall be indexed from 2010 to 2025 or 2001 to 2025. From where indexation will be done? When indexation will be done? When indexation will be done? Sir, legally indexation should be done from this date. But there was a case law of Manjula J. Shah. There was a case law of Manjula J. Shah from, it was at Bombay High Court, that it can be done from here as well. Indexation can be done from here as well. Okay? Indexation can be done from 2001 as well. We follow this case law only, therefore indexation has to be done from 2001 only. Ideally, if examiner does from 2010, he is not wrong. If you see a suggested answer in where indexation is done from 2010, it is not wrong. But wherever indexation is done from 10 now, there would be an alternative answer which would say that indexation can be done from 1 as well. So always 1 has to be considered while indexing. Okay. So 1 shall be taken. What shall be cost of acquisition? 15 divided by 100 into 376. That is 54.4. Index cost of improvement. 10 lakh shall be indexed. 10 lakh shall be indexed from 2006 to 2006 to 25. What is the indexation number? Arey baap re. Again, we have to calculate, we have to find that out. 2006-7 is 122. 122. Index cost of improvement on 35 lakh into 376 divided by year of indexation is nothing but 16. So 1617 would be 264. Okay. So 10 divided by 122 into 376. This would be 30 lakh 81,000, 82,000. 35 divided by 264 into 376. 49.85. All in all, capital gain turns out to be 200 minus 54.4 minus 30.82 minus 49.85. Therefore, 64.93 would be capital gain. And 50 second, just a second. Dia is saying that index cost of acquisition is something. 15 divided by 100 into 376. 56.4, yes. So it will be 62.93. Minus section 54 EC. Here capital gain exemption would change. 50 lakh exemption. Then 12.93 would be the considered capital gain. Index capital gain. Now here we would have 20%. 20% of 12.96. 12.93 actually. So 2.586 is the capital gain amount. 2.586 would be capital gain tax. It would be tax. Okay, 2.586 capital gain taxes. This is how you have to solve. Are we done here? Are we done here? No, 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 dear, no. You are not done here. Who will add surcharge to this? Because your total income is more than 50 lakh rupees. Who will add surcharge here? Examiner is going to come? No. You have to add surcharge. Sir, you have to add 10% surcharge to this plus 4% education cess to this because total income is more than 50 lakh rupees. I hope you got the question. How do we solve it? I hope you got the question. How do we solve it? Okay. Some extra pointers now. Some extra kullu pullu sa pointers are to be done. Some extra kullu pullu sa pointers we have to discuss. Okay. Otherwise, chapter is entirely over. Some small pointers I have to discuss which are really crucial. Okay. Yes, sir, we are able to do it. We are able to do it. See, once we solve questions now, we get comfortable. This example was the classic example where most of the things are covered. Exemptions are covered as well. Indexation is covered. From previous owner is also considered. This example, we take this example. Okay. We usually take these examples now. What is left? Listen. A few pointers are left only. Just listen to these points. Huh? For example, there is a person named Joey Tribbiani. There is a person named Joey Tribbiani. He was very optimistic about India. You know, optimism, filled with optimism. He is not filled with blood. He is filled with optimism. Too much optimistic about India. So he invested 10,000 US dollar in Rahul Private Limited in 2016. At that time, na, US dollar was 70 rupees. So he invested 7 lakh rupees in Rahul Private Limited. Okay, correct? Okay, perfect. Rahul Private Limited grew. It grew significantly. And in 2025, these 7 lakh worth of shares are now 12 lakh rupees. Oh, wow. Oh, wow. These 7 lakh have turned 12 lakh rupees. Such a opportunity, such a optimism. Wow. Okay. As soon as capital appreciation was there, na, somebody came with open hands. Hey, Baba, where is the tax? Somebody came. Who would come? Who, according to you, would come and ask for taxes? Didn't Baba? Taxes, who would come? Somebody would come for asking the taxes. That somebody is asking taxes on 12.5 lakh rupees. Somebody is asking taxes on 5 lakh rupees. Joey said, okay. When he took this money outside, of course, he would not take rupees with himself. No, so he converted dollars. At that time, exchange rate had hit a century. And if you see how much dollar he would take, he took just $2,000, $12,000. He just took $12,000. Just think of him. Just think of him. He made a profit of just 20%. Just 20%. In reality, he did a profit of just 20%. But if you see Nimotai, you understand a Nimotai, apni finance minister. If you see Nimotai, she is charging taxes on nearly 70%. His profit is just 20%. In fact, in real terms, his profit is just 20%. But Nimotai is charging taxes on this amount of 5 lakh rupees. Don't you think it is a cheating on him? Don't you think it is a cheating on him? So it is not cheating. It is rupee depreciating, or I should say dollar appreciating, whatever it is. Whatever the actual gains of 5 lakhs are there now are disregarded because of rupee depreciation. Your rupee depreciation is so significant that these capital gains become insignificant. This is what happens mostly when foreigners invest in India. Na? Their rupee depreciation is so much, dollar depreciation is so much, whatever it is, that capital gain becomes senseless. It appears that he has got 5 lakh rupees of capital gain, or I can say as a percentage terms on 7 lakh rupees, he must have got 67-70% gain he has got. But in fact, he has just got 20% because majority of his gains have been wiped out in foreign exchange fluctuations, in rupee depreciation. How would we deal for this? For this, there come proviso 1. Proviso first to section 48. What this proviso 1 to section 48 says, this proviso talks about one thing. Whenever a non-resident foreign company invests in securities, invests in securities in India. With securities, sir, unlisted securities, or specifically if I am saying securities other than 112A, securities, other than 112 securities, then capital gain shall be computed in foreign currency. How it shall be computed, understand. For example, Joey Tribbiani, how case was, full value of consideration was 12 lakh rupees. Cost of acquisition was 7 lakh rupees. Capital gain turned out to be 5 lakh rupees. This was the case in India. This is not how things are going to be taking place. Full value of consideration shall be converted into dollar. How it will be converted? With the average of buying plus selling rate on date of sale. The date of transfer shall be taken. On that date of transfer, take the average of buying and selling rate. With that, you would convert. Sir, assuming average rate is 100 on that day, so it will be $12,000. $12,000. Similarly, if we have any transfer expenses would be also converted based on average rate, assuming we have no transfer expenses right now. Cost of acquisition. So this shall also be converted into dollar with an average of buying and selling rate on date of acquisition. A full value of consideration shall be converted with date of transfer, and cost of acquisition shall be converted with the rate on the date of acquisition. Assuming it was 70 at that point of time. So 7,000. Sorry, it was not 70, it was 70, so 10,000. Now we would arrive at a capital gain which would be in dollars, because full value of consideration is in dollar, cost of acquisition is in dollar, so profit will also be in dollar. We want to charge taxes in India. So for that matter, this foreign currency, this capital gain would also be converted, but not with average rate, but this would be converted with a buying rate. Buying rate on date of transfer. Whatever the date of transfer buying rate is, that shall be taken. Assuming it is 100 only. So in this case, 2 lakh worth of capital gain would be charged to tax in India at the rate of 12.5%. 2 lakh rupees. And remaining 3 lakh is nothing but remaining 3 lakh is foreign exchange fluctuations gain or loss. That shall be ignored. Did you understand this example? This example is the biggest thing that you can take away. Every other thing that you have in the book now is going to forget. You are going to forget everything. See, this is the paragraph. I'm making you read this, but you will not understand a bit of this paragraph unless you are familiar with the example. That example should be on your heart. That somebody investing in India, somebody investing 7 lakh rupees and he gets 12 lakh rupees in return. Most of the profit is wiped out in foreign exchange fluctuations. That example should be in brain because this is going to be forgot. You are going to forget this. Example is going to remain. Capital gain in case of non-resident foreign company on sale of share debentures of an Indian company which are acquired, purchased, then capital gain shall be calculated in foreign currency. Whatever capital gain is there will be calculated in foreign currency and then reconverted into Indian currency. Which rates are going to be used? See, whatever the full value of consideration is and transfer expenses, that shall be taken as average of buying and selling rate on the date of transfer. Take the date of transfer and take the average on that date. Cost of acquisition shall be converted with the average buying and selling rate on the date of acquisition. And buying rate, capital gain into India, because capital gain will be in dollars, so it shall be converted with the buying rate on the date of transfer. Remember, assessee should be non-resident in the year of transfer and indexation benefit is not allowed. This was the first proviso to section 48. This was the first proviso to section 48. Second proviso to section 48 talks about indexation. The second proviso talks about indexation, that if an asset is transferred before 23rd July 2024, then cost of acquisition shall be taken as index cost of acquisition. This is what second proviso talks about, that is indexation. Third proviso is very crucial, very crucial, sir. If you transfer securities referred under 112A, neither indexation is allowed, neither any indexation is allowed, nor this conversion is allowed. That means if Joey Tribbiani invested into shares of Reliance, then no, this conversion benefit is not allowed. This foreign exchange fluctuation gain or loss which is ignored, that is not allowed. This point also asked in Jan. The way I'm telling you, the same thing I had taught to students who came in Jan 26. The same example I took. But issue there was those shares that have been given in the question and the exam were listed. Third proviso clearly states that if you have securities under 112A, in this case, neither you have to index that, nor you have to take this foreign exchange fluctuations gain or loss. You don't have to convert them as well. You don't have to convert them. You are not required to convert if they are listed. If you see the question, I have that question. That is why I was saying that question was doable. That is why, because we have discussed this point in class. Just let me show this point to you. This was a 2C. Manoj was born in India. I mean, there was somewhere mentioned. Something was mentioned. Let me show you. He invested in 13 lakh rupees in listed shares of a domestic company in 2012. Consideration was paid in USD and they were sold for 15 lakh rupees. Entire consideration was in listed equity shares. Therefore, first proviso is not even applicable here. So third proviso was this. Fifth proviso is ignorable. Same thing that we discussed now is with respect to rupee denominated bond. Sixth proviso is also ignorable. Whenever you receive any ESOPs, so cost of acquisition for the ESOP is nothing but the FMV on which the conversion takes place. Seventh proviso is a bit logical. What it says, see, whenever you pay securities transaction tax, under capital gain head, securities transaction tax is a dead expense. Neither you can reduce it from full value of consideration, neither you can claim it as transfer expenses, nor you can Add it to cost of acquisition. So securities transaction tax is a dead expense for capital gain. But if you are having a business of share trading, then it is allowed under PGBP. But under capital gain, it is a dead expense as per 7th proviso. Okay? Come on to chart. Where do we stand right now? Come on to chart. We did provisos. We did exempt transfer. Okay. Come on to last two topics, that is basic exemption limit. Set of this you will see towards the end of this chapter. Towards the end of the chapter. Last second page. What is this limit? What is this basic exemption limit? Understand this now. For example, as of now, you are not required to pay taxes if your total income is up to 2.5 lakh or 4 lakh under 115 BAC. Yes, you are not required to pay any taxes. We call it basic exemption limit. We call it basic exemption limit. For example, somebody named Monica has short-term capital gain under section 111A for 3 lakh rupees and no other income. No other income. She has no other income. Can I set off this short-term capital gain from this basic exemption limit? Can I set this off, or she will be required to pay 20% taxes, that is 60,000 rupees? Can I set off this Can I set off this short-term capital gain from the basic exemption limit? Can I set that off? Can I set that off? Hmm? Not available to non-resident. If Monica is a non-resident now, if Monica is a non-resident, she has to pay the taxes. She has to pay the taxes. If Monica is a non-resident, na bhaiya, it is irrespective. Your basic exemption limit is separate. Your every income which is taxed at special rate, you have to pay taxes. No basic exemption limit set off is allowed to a non-resident. If Monica is a non-resident, na, you cannot claim any set off of basic exemption limit. No set off is allowed at all. No set off is allowed at all. At all, no set off is allowed. In any case, whatever income you have, sir, even if you have 1 rupee of capital income, you have to pay taxes. As a non-resident, you have to pay taxes even on 1 rupee as well. Even you have 1 rupee of lottery, you have to pay taxes. No benefit at all to a non-resident. Sir, what about resident? Resident. Oh, resident. Okay, I see. Do residents have a benefit? Right answer is, sir, if you are AOP, if you are BOI, if you are artificial political person, again, no benefit. But if you are resident individual and HUF, you are given benefit. You are given a benefit. How much benefit? Sir, you are given benefit on 11111A, 112A, and 112. On these three incomes, you can set off against basic exemption limit. We can set off losses from, we can set off these incomes from basic exemption limit. Other incomes, not allowed. Not allowed. I will take an example to make you understand. Don't worry. I will take an example. For example, we have with us Mr. Satish. He is opting for 115 BAC. His business income is just 1 lakh rupees. His short-term capital gain under section 111A is 90,000. His lottery income is 50,000. His LTCG 112A is 1.5 lakh. His LTCG under section 112 is 1 lakh. Change this business income to 2 lakh. Or change it to 2.5. It is better. Calculate taxes. Calculate taxes. How do we calculate the taxes in this case? Listen. First of all, lottery will be taxed as it is. There is no benefit on lottery. Whatever this lottery income is now, this would be taxed at 30% only. 15,000 tax is to be paid mandatorily without any choice. This has to be paid, no strings attached. On business income, can I say that we have 4 lakh of basic exemption limit? Therefore, I have told you base of 115 BAC. So 4 lakh we don't require to pay any taxes. So 4 lakh is the basic exemption limit. Out of this 4 lakh, 2.5 lakh we have exhausted. That means we have 1.5 lakh of unexhausted basic exemption limit. Can I say that? Yes. I have 1.5 lakh of unexhausted basic exemption limit. That means on business income, I am not required to pay any taxes because it is within the basic exemption limit. So this unexhausted basic exemption limit can be used against this 111A as well. This can be used against 112A as well, and this can be used against 112 as well. Against which income I should be setting it off? Against which income I should be setting it off? Sir, the income against which highest taxes are to be paid. Highest taxes are against 111A. So we would set off against this. That means out of this 1.5 lakh, 90,000 is used. 90,000 is used. That means 60 lakh is still left. 60,000 is still left. Now we don't have to pay taxes on 111A as well. Now we don't have to pay taxes on 111A as well. Now the 60 lakh can be used against 112A and 112. Which one should I be using? Which one should I be using? Which one should I be using? 112. 112. Everybody said it correctly. Everybody said it correctly. 112. Why? Because sir, on this we are already getting the 1.25 lakh wala benefit. On this we are already getting 1.25 wala benefit. On this we are already getting 1.25 wala benefit. So 40,000 into 12.5% will be our taxes. 5,000 on this, and on 25,000, 12.5% will be our taxes. That is 3125. Totaling this, our tax liability turn out to be 23,125 plus 4%. This is how tax liability would turn out to be. One more question for value addition. One more question. Do you want your high intellect to be used? Do you want? Sir, please test us. These can be tested in MCQ. Same Satish is opting for old regime. Sir, business income is 1 lakh rupees. Short-term capital gain is 90,000. Lottery income is 50,000. Long-term capital gain under 112A is 1.5 lakh. LTCG is 112 is 1 lakh. Now what shall I do? What should I do? Let's make it a bit more simpler. Let's make it a bit more simpler. To make it, I mean, I should not make it simple, but more complicated ones. Let me do it for you. Take lottery as 25,000. Now solve it. Now solve it. Try doing it. Or should I do it with you? Sir, do it with us. Do it with us. See, on this business income, you have 2.5 lakh, 2.5 lakh basic exemption limit. That means on this 1 lakh, we don't have to pay any taxes. And 1 lakh is used, therefore 1.5 lakh is unused basic exemption limit. Against this basic exemption limit, which income should be set off? Of course, sir, you all answered this thing previously only. So short-term capital gain. Short-term capital gain should be set off because it is taxed at 20%. So this will be set off minus 90,000. 60,000 is left. No taxes on short-term capital gain. This lottery, we know we have no choices but to pay taxes. 25,000 into 30%. 7,500 taxes are to be paid. Yes. Yes, 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 yes. Now tell me, where should I use the 60,000 rupees? 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 Use your brain as a chartered accountant. Use your brain as a chartered accountant. Ideally, I should not be giving this much time to this topic. Honestly, it doesn't deserve. But I don't know. What should I say? That anxiety cannot stop it. My anxiousness to tell cannot stop it. 112. Monica says 112. Monica says 112. Yes. Can I change your answer? Can I suggest you something better? Sir, out of the 60,000, use 25,000 from here. Use 25,000 from here. This will be not taxed now because up to 1.25 lakh, we don't have any taxes in 112. And remaining 35,000 used from here. That is 65,000 into 12.5%. 8,125. Sir, why did we choose 112A? Because, sir, on 112A, rebate under 87A is not available under old regime. Therefore, we did choose this. Overall, our taxes are 7,500, 15,625. Now, the same thing, we are available with 87A rebate and 12,500 would be the tax rebate amount. 3,125 is the final tax payable, and on this surcharge, education cess would be added. Did you understand what what type of brain we thought? Did we understand what type of thought we took? Of course, I personally do not think of examiner asking this thing. I do not think, but it is a point worth thinking. You have to use basic exemption limit very wisely. What if examiner asks such thing in MCQs? You don't know. Na. And if we have this privilege, see what I was looking at. We were going sufficiently ahead of time. Therefore, I discussed that. We were not late. We were going well on time. Therefore, I discussed that. If we were short of time, I wouldn't have discussed the same thing. Yes, sir. Understood. Okay. Now, when do we consider a share held with us as a stock in trade or capital asset? Why is it necessary even? So it is necessary because if we hold such share as a stock in trade, now it would be our PGBP income, it would be taxed with slab. But if we hold them as capital assets, then we would have capital gain and lower tax rate. So it is necessary for us to identify under which category we are keeping them. How do we decide whether they are stock in trade or whether they are capital asset? In that case, so there are 4 pointers to be considered. If our objective is to earn dividend from them, then it is a capital asset. Of course, if your objective from a security is to earn dividend interest, then it is a capital asset. But if your objective is to earn from price fluctuations, then it is stock in trade. If your quantum of purchase and sale is very high, very, very, very high, there are greater chances that these are stock in trade. But if your quantum is very low, once in a year you are buying, selling, then these are capital assets only. Your period of holding, sir, your period of holding is 5 to 7 years, it is always a capital asset. But if your period of holding is just 1 to 2 days, then it is a stock in trade. Treatment in your books of accounts, sir, if you yourself treat such securities as stock in trade now, department is not going to argue. If you yourself treat stock in trade, department is not going to argue. If you yourself treat stock in capital asset, now department at first is not going to argue. Therefore, treatment matters the most. What AO will decide, listen, what AO will take in account in deciding whether these are stock in trade or capital asset? Sir, first of all, he will consider all the above 4 pointers. All the above 4 pointers he is going to consider. Second thing, if assessee treats shares or securities as a stock in trade, assessee treating as a stock in trade, AO is not going to argue at all. AO is not going to argue at all. Because if assessee is willing to pay 30% taxes, AO is not going to argue. Why will he argue and ask assessee to pay lesser taxes? He will never argue. Next point, sir, if assessee is selling any listed securities who has been held by him for 12 months, 12 months or more, then it shall be, and he assessee also offering under capital gain, in that case, AO is not going to argue. Unless assessee himself changes the stance, otherwise AO is not going to argue. Sir, another important point, provision says if assessee sells any unlisted shares, by default, selling of unlisted shares is capital gain only. But if there is genuineness of the transaction is questionable, or if there is lifting up of corporate veil, then in that case it can be changed, it can be questioned, and it can be still classified as PGBP. Reference to valuation officer. See, you don't have to remember this. Just remember, if we have claimed FMV, if at multiple places FMV was required to be claimed when we buy property, FMV as on 1st April 2001, there were multiple FMVs involved now. Provision says if we have taken FMV based on the report of a valuation officer or based on the report of a registered valuer, in that case, if AO thinks that there is greater variations from actuality, he can refer the case to valuation officer. In other cases, if we self-declare our FMV, we can also self-declare in some cases. In that cases, now, if AO thinks that difference is more than 15%, or if difference is more than 25%, or whenever he thinks necessary, he can refer the case to valuation officer. AO can refer the case to valuation officer. So side pocketing you can ignore. I don't think that is important. One important pointer, sir. Sometimes what happens, we have been holding land. Okay? We have been holding land since 2001. It is 2025 today. And we constructed a building on this in 2024. We bought building and we bought land as well. Building has been constructed last year only, but land has been in existence for more than 20 years. In 2025, we sold them for a joint agreement, for a single agreement, that is for 2 crore rupees. In this case, provision clearly states that land is a long-term capital asset, building is a short-term capital asset. Whatever the capital gain on account of land will be, it will be long-term capital gain. Whatever the capital gain on account of building is, it will be short-term capital gain. Sir, but we are receiving 2 crore rupees as a composite money. How do we decide how much is for land and how much is for building? Sir, you have to segregate that based on fair market value, and fair market value would be given to you in question. Whatever the FMV of land is, that proportion shall be used for full life consideration of land, and whatever the FMV of building is, you have to use that proportion for determining FEOC of building. Based on that, capital gain on land would be long term and capital gain on building would be short term. Sir, segregated portfolio, also understand why to leave this topic if we have time. Now, what is segregated portfolio? Very simple pointer it is. See, for example, I invest in a mutual fund. Okay, I have invested 1,000 rupees in a mutual fund, and mutual fund has 1,000 rupees only. It had invested into different companies. Out of my 1,000 rupees, 800 investment are in good companies, but 200 investments are in bad companies. Bad companies, say Byju's, which is already dead. No existence. Out of 1,000 rupees, 800 investment is good, but 200 is really bad. Now, just think of it practically. If somebody invests into a mutual fund, his money is directly apportioned into the same split. More money would go to good companies, more money would go to bad companies because split remains the same. Whatever the investment is remains the same. Why would an investor invest in this mutual fund if he knows that some portion goes to buy juice? Are you getting me? The more money you chip in a mutual fund, that money is split into multiple different asset classes, different shares of the company. Why would somebody invest in a mutual fund where he knows that 20% is going to buy juice? His investment is going to distort at that point. So in this case, what these mutual fund does, sir, they separate this bad performing investment. For example, I have 100 units of 100 NAV. What they do is they split this NAV. They would give us 100 units of 80 NAV, which is a good unit, good mutual fund, and they would do 100 units of 20 NAV, which will be segregated portfolio. Now, what they will do of the segregated portfolio, they will not allow me to sell. Unless they realize money from the Byju's, they will not let me sell this, or they will not give me any money against this. And this will not be shown to anybody. Anybody who wants to invest will have only 80 as NAV and he will be directly investing in good companies only. So this is what segregated portfolio they do. Now, what is relevance for us? So relevance for us is nothing. It is a kind of demerger only happening. If a mutual fund has 1,000 crore of good investments, okay, and I have one unit of such mutual fund for rupees 500. Out of this 1,000 crore, 20% went bad. Out of this 1,000 crore, 20% went bad. How much of my 5,000 went bad? So 20% went bad. Na? So 1,000 crore would be cost of segregated portfolio, cost of acquisition of segregated portfolio. The same we did in demerger is the same thing that we do in segregated portfolio. But concept has to be understood now. What is segregated portfolio? That's it. That is it. That is it. This is only you have to solve. This is only what you were supposed to know in capital gain. Entire capital gain is done. Unexpectedly done. Faster than what I had thought. Now, you can take a screenshot of this. Huh? You can take a screenshot of this capital gain screenshot. These are questions that you have to solve. These are the mandatory questions. These are 9 questions from capital gain chapter that you should solve. These are super 100 questions. Of course, I'm making a list of super 100. Most of it is done. Maybe I'll release it today only. This questions you have to solve. Out of this, Mr. Prem we have done, Salsi we have done. These two questions we have already done. Shivansh, I have given you as homework. Write this question as daily practice question SSPL. Question number 31 SSPL. Day 3, DPQ 3. Question number 31. Capital gain SSPL. A good question to practice. Do write it down today. Now just tell me, should we practice question answers? I have to make you I have to solve these super 100 questions with you all. But issue here is my voice is not clear. My voice is not syncing with the actions. Now, so this will create issue with you. You will not be able to solve along with me. Should we start IFOS? Should we start IFOS? We'll solve question answers. Don't worry. We have made examples and solved in class, so you can trust on that point that we will solve the remaining questions on capital gain as well. So that is not the issue. But voice is not syncing. I think you will not be able to participate with me if voice is not syncing. That is the issue I'm thinking. So why should not we start with IFOS? Let's start with IFOS. What's the issue? Yes, sir, we can start with IFOS. We can start with IFOS. Let's start with IFOS. See, I wanted to solve question answers. I was well prepared. कि आज ना मैं question answer कराऊंगा. I was well prepared. But the fact is, voice is not syncing. You will not participate. Now, my pencil will say something. My mouth will say something. For concept, it is okay. But for question answers, it might not be okay. Let's start with IFOS. Now. Okay, sir. Okay, sir. Okay. Sir, Can you tell me what was the charging section of PGBP? Sorry, not PGBP, but capital gain. What was the charging section of the capital gain? Can you all say? Can you all narrate the charging section of capital gain? What was the charging section? Sir, it was 45-1. We are aware that it was 45-1. Any gain arising from the transfer of capital asset shall be taxable under the head capital gain. Similarly, we have charging section of PGBP as well. Beautiful, Satish. Beautiful, Monica. Similarly, we have charging section of PGBP as well, which lists down certain things which are taxable under that PGBP. Similarly, we have charging section of salary as well, section 15. Similarly, we have charging section for house property as well, section 22. Likewise, we have charging section of IFOS, which is very clear. The clearest charging section of all. IFOS simply states that first go to other heads. Go to PGBP, go to IFO, go to capital gain, go to salary, go to house property. If you do not fall anywhere, just come on to IFOS. Just come on to IFOS. What it says, if any income which is not chargeable under that salary, not house property, nor PGBP, nor capital gain, and it is also not exempt. Any income which is not chargeable under any head, plus it is also not exempt, then it is taxable under the head IFOS. It is a topic now which has depth. To be honest, it has good, decent depth in itself, but it is not tested. I don't know why at CA final level, na ICI never tests IFOS. At inter level, we have too much of depth in this, but at final level, it is not tested a lot. So the efforts we put in should be proportionate to the marks that they ask. Okay? I will still cover the depth the way we did in capital gain, na? But you need to understand the depth in this topic is too much than what is being asked. Sir, we got this point that first of all, any income that we see has to be checked for different heads. If they do not fall in different heads, then we have to come to IFOS. If they don't fall under any other head, they have to be checked for IFOS. Got it, sir. Got it, sir. Got it. Absolutely got that point. There are certain examples which are taxable under IFOS. There are certain incomes which are meant to be taxed under IFOS, and here is a list of them. We'll discuss one by one. First of all is dividend. Dividend is a beautiful income. Sir, what is not beautiful? Everything is beautiful to you. Dividend is really beautiful. Why? Because dividend is IFOS for everybody. Even if you receive dividend as capital asset, it will be IFOS. Even if your business is stock trading and you receive dividend, it will all be IFOS. If you are a FII, then too it would go to IFOS. If you are an investment banker, then too it would go to IFOS. If you are a mutual fund, then too it would go to IFOS. Whatever business you do, dividend income will always be IFOS. For everybody, dividend income would be IFOS. Everybody, irrespective of the category. But still, we have too much of depth to be discussed in dividend. We will discuss that later on. Interest on securities, bank deposits, loan given, IT refund. Interest income is also IFOS in most of the cases. We will discuss this as well later on. Winnings from lottery, puzzle, online gaming. If you win any kind of lottery, any online games, this is taxable under IFOS head only. But these two are to be discussed in some other chapter. First chapter basics we will discuss after PGBP. Income from letting out of plant and machinery and furniture. For example, if you have plant and machinery, sir, not just plant and machinery, listen. If you have any house property, sir, house property would go to house property. But if you have any plant and machinery, it would go to IFOS. If you receive any rent on plant and machinery, it would go to IFOS. In addition to that, if you receive rent on land, that shall also go to IFOS. Rent on land shall also go to IFOS. Even subletting is also IFOS. Subletting. Sir, what is subletting? We don't know. For example, you live in Chennai. You saw 2 BHK flat. You saw 2 BHK flat. You got that 2 BHK for 20,000 rupees. Okay. You got this 2 BHK for 20,000 rupees. Now, what you would do of this 2 BHK? You require only a 6 by 6 mattress to sleep. That to 6 by 6 is enough. 4 by 6 mattress is okay for you to sleep. What you would do of this 2 BHK? You found somebody who requires one room. So you charged him 13,000 rupees for one room. For one room. This is nothing but subletting. You took it on rent and you rented out to somebody else. This is subletting. In this case, your rent received is 13,000 rupees and rent expense on this rent is 10,000 rupees because for one room you are required to pay 10,000. So this 3,000 rupees is the income from subletting and this income goes to IFOS. Okay? Subletting is kind of IFOS only. Okay? Any money received on scheme and insurance policy. This is a point worth discussing. This is a point worth discussing. Okay, listen point carefully. For example, this is Reliance. Reliance's P&L. As of now, for Reliance, the most important person in the industry is Mukesh Ambani. For Reliance, most important person is Mukesh Ambani only. If health of Mukesh Ambani goes down, it will be lost to Reliance. It will be lost to strategic decision making. Therefore, health of Mukesh Ambani, life of Mukesh Ambani is very important for Reliance. Therefore, Reliance annually pays 100 crore rupees as insurance premium. Insurance premium. If anything happens to Mukesh Ambani, Reliance would get 5,000 crore rupees. It is like a wagering. It's like a bet. I am betting on the health of somebody in my organization. If anything happens to him, my organization will suffer. Therefore, to compensate that loss, organization is getting an insurance. Does Mukesh Ambani has to do anything here? No, sir. Mukesh Ambani has to do nothing in this case. Sir, will this expenditure be allowed? Yes, any expenditure on the benefit of the employees is allowed. Mukesh Ambani is the employee. It is allowed. It is allowed. It is allowed. So if any money is received, will that be taxable? Sir, it will be taxable and it will be taxable under the head PGBP. So if you pay any insurance on key managerial personnel, if you pay managerial on key managerial personnel, key managerial person, that insurance expenditure is allowed. In addition to that, the income is taxable under that PGBP. Same thing you will see when we will study charging section of PGBP. I will repeat this point again. When you see charging section of PGBP now, charging section of PGBP, you would see the same thing. Any money received from Keyman insurance policy. Whenever you buy any Keyman insurance, insurance expenditure is allowed as PGBP. Similarly, income is taxable under that PGBP. Expenditure is allowed and income is taxable. Now think of the brain. What Dhirubhai Ambani did. What Dhirubhai Ambani did. What Dhirubhai Ambani did. Listen. Since for Reliance, most important person is Mukesh Ambani. Okay. All of a sudden, Reliance said, for us, Mukesh Ambani is not relevant. For us, Mukesh Ambani is not relevant. There is a Bengali Baba who lives in Himalaya. There is a Bengali Baba who lives in Himalaya is important to us. His life is important for the functioning of the Reliance. His life is important for the function of Reliance. There is a Bengali Baba who lives in Himalaya. The more breath he takes, the better Reliance grows. His life is important for Reliance. And therefore, Reliance was paying insurance premium for that life of the Bengali Baba. Insurance was being paid for the life of the third person, a Bengali Baba, who stays in Himalaya. Do you think the department will allow the expenditure? Do you think the department is going to allow the expenditure? Do you think that department is going to allow this 100 crore? See, if you pay for employee, if you pay for key managerial person, it is allowed. But if some Bengali Baba, random Bengali Baba who stays in Himalaya, for that person you are buying insurance, do you think that government will allow? Sir, government will not allow this. Exactly, this is what Dhirubhai Ambani wanted. This is what Dhirubhai Ambani wanted. He wanted expenditure to be disallowed. Therefore, he can claim the income also, the exempt ones. If something happened to Bengali Baba, your expenditure was disallowed now. So your income should also not be taxable. Income should not be taxable in the hands of Reliance. If expenditure you are not allowing because of personal nature, this income should also be capital receipts because it is not related to business. It will not be taxable. And there was no provision as to tax it. Are you getting me this point? Are you getting this point? This was psychological game played by Reliance back in 2001 that if we pay any expenditure on the life of Dhirubhai Ambani, see Dhirubhai Ambani retired. Dhirubhai Ambani retired. For Mukesh Ambani, if any insurance premium is paid, he is an employee of the company. He is the key managerial person of the company. But if we pay any insurance for the life of Dhirubhai Ambani, it was not allowed. If it was not allowed, so any income received should not be taxed. This was not taxed. Therefore, what department did not? Department amended the section 56(2) and it clearly said, just a second. Department amended this section as said that if you receive any key managerial personal insurance money which is not taxable under the PGBP head would go to IFOS. This was the intention. See how business houses used to confuse the lawmakers. They knew that expenditure is going to disallow. Therefore, income would be non-taxable. And insurance was not taken for a Bengali Baba. Insurance was taken for Dhirubhai Ambani, who was a retired person. Reason was stated that he is necessary. His life is necessary for the business. If he blesses Mukesh Ambani, business would foster. This was the explanation given. This was the explanation given. But department would disallow the expenditure because Dhirubhai Ambani is not the key managerial person. Expenditure would be disallowed. So income should be exempt. But department changed the law. At that point of time, law was amended and therefore any key man insurance policy which was not taxable under PGP would go to IFOS. Okay, sir, got it. Interest received on compensation on acquisition, as we discussed in the morning only, that if our property is compulsorily acquired, if we have any property which is compulsorily acquired, now what happens in case of compulsory acquisition? Sir, we receive money, we receive initial compensation, we receive enhanced compensation, we also receive interest on compensation as well. I had told you this interest on compensation would go to IFOS head and you get a standard deduction of 50%. This is what here is mentioned. If any interest on compensation is received, it would go to IFOS. Advance money forfeiture on or after 1st April 2014. If you remember, advance money, if we want to sell the house, if we receive any advance money, and we forfeit that, it is taxable after Modi government coming into picture. If you remember now, Modi government coming into picture 1st April 2014. Modi government coming into picture and advance money is being forfeited. In that case, what would happen? In that case, it would go to IFOS. If advance money was forfeited before 1st April, then it would be reduced from cost of acquisition. Gift taxation. Too much to discuss in gift taxation. Too much to discuss. We will give sufficient time to this gift taxation. You don't worry. Gift taxation is important. We will discuss this when we will study gift taxation. Okay? But remember, gift taxation is only from the recipient point of view. You are receiving a gift. You are receiving a gift. From recipient's point of view, you have to understand this gift taxation. Sir, family pension, yet another topic to be discussed. What is family pension? See, what happens if you are in a government employee, not right now, but somebody who was into government employment way before back. I mean, 2000, 2001 was the year, was the cutoff date. If you were employed before that, so you were given pension. Any government employee was supposed to get pension. Any government employee was getting pension. Now, if somebody retired and he received a pension, that was taxable under that salary. If you are an employee, government employee, and you get pension after retirement, that pension would be taxable under that salary. But there were many employees who used to get pension after their death as well. There were many government employees who used to get salary even after their death as well. And this pension was received by their family, and this is called family pension. After the death of the SSC, if any pension has been is being received, a monthly pension is received by the family members, it is called family pension. And somebody who is receiving it is not their salary now. It is IFOS. Why it is IFOS? Why it is IFOS? Because family is not receiving this pension on account of employee-employee relationship now. See, if Radhe Radhe Sir Kanika, Radhe Radhe. Oh ho, Kanika. Kanika has been ours. I mean, I guess September 25 she cleared, I guess. And she has been always coming to our class just to say Radhe Radhe. Heartfelt Radhe Radhe. I mean, Kanika, really, really, really appreciable for your kind efforts for coming in class. Okay. Just to message me. Thank you so much. Thank you so much, Kanika. Now, what were we discussing? Family pension. See, if you are a government employee, during the work, you get salary that is taxable under that salary. After retirement, you get pension that is also taxable under salary because you receive as employee and there is employee-employee relationship involved. But after death, your family would receive the money. And if your family receives the money, then in that case, it is family pension. It could go to IFOS. There is too much to discuss later on as well. Do you remember somebody coming to your house at the time of elections? Do you know? Do you know somebody coming to your house wearing a hat, wearing white kurta, having such a big fat belly that they are not able to see their feet as well? Always support you. Thank you so much. Thank you so much, Kanika. Do you remember somebody coming to your house times before election, such a fat belly that they are not able to see their feet themselves, just begging you for votes? Do you remember somebody? Yes, sir. Everybody comes to our house just to seek our vote. Who are these? Sir, these are not employees. These are not professionals. These are servants. These are volunteers. I don't know what we call, but in Hindi we call it seva. They do seva. If they are being elected as member of parliament, member of legislative council, member of legislative assemblies, if they are MPs, MLAs, MLCs, they receive money every month. They receive money every month. Provision says these money that they get now, it's not salary. They are not doing any job. They'll not get salary. They are not getting any job. They are not doing any professional services. It is not also PGPP. They are doing seva. They are doing volunteer work. It's just to serve you. They are just doing for a social cause. How can we tax it under salary? Therefore, any any money received on account of MP MLA, any received any salary received by MP MLA shall go under IFOS. It will never go under salary. It will never go under PGBT. Got it, sir. In addition to that, any daily or constituency allowance received by them is exempt. They receive daily allowances, they receive constituency allowances, that is also exempt in their hands. Wow, sir. Wow, wow, wow. Undisclosed income. For example, Monica. Monica house was under survey. Monica's house was under survey. Department officers came. They were searching out for some hidden evidences, hidden assets in the Monica's house. But Monica was not disclosing. Monica was not disclosing. All of a sudden, the officers went really angry on Monica. Really, really, really angry on Monica. Officers were so angry that they was just about to hit the Monica with the stick, but they didn't. The officer just threw the stick on the wall. Department came to Monica's house to survey the house. They were very angry to find out the assets. They were very angry. They were supposed to beat Monica, but they didn't because, of course, they want to save themselves now. So the officer just threw the stick to the wall, and there was a sound, tongue. There was a sound, tongue. Officer knew something is hidden there. He went to wall and did tick tick. There was a sound, tongue, tongue. Again he did tick tick. There was a sound, tongue, tongue. When he saw the wall properly, it was found that wall was made up of gold. Here 10-gram gold is of rupees 2 lakh rupees. Her entire wall was made up of gold, 100 kg of gold. 100 kg of gold at her home. Officer was astonished to find out. When Monica was asked, where did she get the money? Where did she get money? She said, it's all God's grace. I don't know. It's all God's grace. One day I was using the stones, all of a sudden stones turned into gold. I put potato from one side and gold was coming the other side. I don't know how come this gold came. Arey, provisions provision says if you have any unexplained income, if you have any unexplained assets at your home now, on which you cannot give the satisfactory explanation, that would be taxable under IFOS only. If you have any unexplained assets now, that would go to IFOS. We would have to study this topic when we will study miscellaneous provisions. Then we have directors remuneration and royalty. What it means, see, if you are a director in a company, ideally directors are employees of the company, so whatever the remuneration director receive, it is the salary, it is taxable under that salary. But if you are a part-time director, if you are an independent director, then you don't receive salary, you receive remuneration as honorarium. You receive remuneration as honorarium. In that case, it goes under the head IFOS. Okay, now listen to this point carefully. Listen to this point carefully. You will not listen to this. You will not accept this point. I know. You will not accept this point. One day I announced power batch, English power, starting 6th March. On the same date, on the same date, Sarthak sir announced power for FR 6th March. I announced timing will be morning 7:30 to 11:30. Sarthak sir did the same thing. Everything same he is doing. No offense, sir, if you are watching that. No offense. I request regularly students to enroll for the batch if you have not enrolled. He is also doing the same thing. I take this silly examples in class. He is also doing the same thing. Everything is doing. You know what? There were set of 100 students who were supposed to take power batches, and 95 students came for DT and only 5 went for FR. This is because of time clash. Sorry, sir. Really sorry for the example. I don't know what are the consequences of taking this example, but okay, I take that risk. 5 went for FR and 95 came for DT. And these 95 also did not enroll. Like you, coming to class but not enrolled. Okay? So do enroll it today only. Yeah? Do enroll today only. This 95 came. 95 came. Sarthak sir went very angry. Normally this is his face. But all of a sudden his face went this. Sir, how can you do this? How can you do this? How can you do this? Nah, stop. From today onwards, you will not teach at fast. Oh my God. You will not teach at fast. You will not teach at fast. I said, why, sir? Why? Why will I not teach? I am doing good. Students are coming. Why will I not teach at fast? Sir said, no, you don't have to teach. I said, sir, why should I leave? He says, no. I said, sir, I will require money to leave because I am leaving students. I am leaving students. It is a cost to students. It is cost to me. Why will I leave? Sarthak sir said, don't worry. I will pay you 20 lakh rupees for not teaching. You don't have to teach for next 3 months. You don't have to teach for next 3 months. Where would this 20 lakh go? Where would this 20 lakh go in my head of income? In which head of income this 20 lakh would go? Where would 20 lakh go? IFOS, Dia says, Monica says IFOS. Yes. 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 What other people say? Sir, it would never go to IFOS. It would never go to IFOS. Just because we are studying IFOS topic does not mean that every income that I ask will go to IFOS. Sir, if there is employee-employer relationship between Sarthak sir and me, employee-employer relationship, then this 20 lakh would go to salary. If there is professional relationship between me and Sarthak sir, this 20 lakh would go to PGBP. But since there is, as an employee, if he's giving, his employer, if he's giving me, it would go to salary. If as a professional person, as a professional fees, he's giving me 20 lakh rupees, it would go to PGBP. It would never go to IFOS. It would never go to IFOS. So why you are discussing in IFOS? To tell you the contrary thing. For example, I was teaching Power Batch and this is not Sarthak sir. I am teaching Power Batch and this there is not Sarthak sir. But there is somebody else. For example, Alan. You know Alan Career Institute quota, NEET, JEE, these IIT ones, the Alan Career quota, or Narayana Institute. Now Narayana Institute saw my potential. He saw, wow, sir, what a great examples you take in the class that students take full attention. Students take full attention. Wow, what are examples you take. He went flattered. He was flattered by the examples I take in the class. He offered me, Rahul sir, just come to teach. Just come to teach. Just come to teach there. We are starting our CA branch. We want you to teach here. We want you to teach DT in Narayana Institute. And he paid me 50 lakh rupees just to leave fast. Just to leave fast, he gave me 50 lakh rupees. In this case, do we have any employee-employer relationship between Narayana and Rahul having employee-employer relationship? No. Is he giving me because of professional fees? No. Thus, it would go to IFOS. If I receive any money on account of termination of employment by the employer, it would go to salary. If by my business associate for non-competition fees I am receiving, it would go to PGBP. But if I am receiving it from some third person who is not even relevant to my syllabus, who is not even relevant to my subject matter, if I am receiving money from him to leave my employment, that would go to IFS. Got it? I hope you got the example. At last, any income which is not taxable anywhere would go to IFOS. Any other income which is not taxed anywhere would go to IFOS. Now, sir, why there is color shading being done? Why color shading? Why this color shading is being done? See, color shading is being done because of multiple reasons. What are the reasons? First of all, whatever the blue ones are there, whatever the blue ones are there, blue ones are to be detailed discussed. There is a detailed explanation to these. Whatever the red ones are there, are discussed in other chapters. And whatever the orange ones were there, these are this much only. Only this much content. No depth at all. Got it? So whatever the things that we have highlighted in blue are to be discussed in depth, most probably tomorrow. Red ones are to be discussed. But he will also become a professional connection, right? Once he becomes the academy. Yes, but right now for the money received right now, I don't have any professional connection. Na? Yeah. If I accept the contract later on, if I join his institute, then it would be professional connection for sure. But right now receiving money would not mean any professional connection. Okay. So these orange ones are this much only salary of MPMLA, this much only director's fees, compensation on termination of employment, human insurance policy. This is this much only. We don't have much depth in this topic. But these blue ones we have to discuss. Since I am thinking that you are enjoying the topic. I want to start with dividend just to tell you the basic for just next 2 minutes, and then we'll be done with it. See, if we have dividend, if a company pays dividend, if a company pays dividend, for example, company earns a profit of 100 crore. Company is being taxed at the rate of 30%, plus, of course, surcharge 12%, plus 4% education. All in all, how much tax turns out to be 100 into 30% into 1.12 into 1.0. For all in all, 35 rupees are taken by in the tax. All in all, company is left with 65 crore rupees, and this 65 crore rupees go to reserves and surplus. When are we going to receive the books? Let me confirm, Monica. Let me confirm from team. Tomorrow there was Rang Panchmet and nobody was there in office, so I'm not sure what to say. I will discuss to team. I will message you out today only. Whatever books you have asked now, I will message you out today only. 65 crore is the reserves. Out of these 65 crore now, out of the 65 crore, if entire money is distributed in dividend, this 65 crore is taxable. For example, Rahul is the only shareholder. Rahul is the only shareholder. Entire 65 crore is received. Entire 65 crore is received to me. It would be taxed in my hands. 30% tax, mostly 30% tax, plus 15% surcharge, because on dividend maximum surcharge is 15%. 4% education cess. Almost 23 crore have been wiped out in taxes. That means out of 65 crore, 23 crore have been wiped off. That means 42 crore is is the money with me at disposal. I mean, can I say that company who is earning 100 crore rupees, paying taxes on 100 crore, dividend is being received to 65, dividend can be distributed 65 crore rupees, and if they distribute dividend, again it would be taxed in the unit holders. That means, just to look at this, company earning 100 crore and I can only have 42 crore in between, just because of twice taxation. Government takes away the 58 crore rupees. I am earning 100 crore and I can use just 42 crore rupees legally. I can just use 42 crore rupees. Don't you think I would try to evade taxes? Don't you think I would try to evade taxes? Don't you think? This is what people do. This is what people do. Dividend suffers double taxation. Once company pay taxes on the profits that they have earned, and when these profits are distributed to the shareholders, it is taxed twice in the hands of the shareholders. It is taxed twice in the hands. So ultimately, double taxation takes place now in the hands of the shareholders as well as company as well. What company try to do? Carefully listen. What companies try to do? I'm just giving you an example. Tomorrow we'll discuss this. What if company has reserves and surplus of 65 crore rupees? They do not distribute reserves. They do not distribute reserves. If they distribute reserves in the form of cash, cash is considered as dividend only. If we distribute anything in the cash to the shareholders out of the profits, it is dividend only. Section 122 of Companies Act clearly states that any distribution in the form of cash out of the profits is deemed as dividend. So what companies try to do? Company tries to fool the department. What they do is, instead of getting the cash, they would give away the land, because giving land is not dividend as per Companies Act. Giving land is not a dividend as per Companies Act. Okay, so they would give away the land. They would also give away, for example, shares. They would give away investments. They would give away investments. Now, these are not considered as dividend as per Companies Act, but these are considered as dividend, deemed a dividend under Income Tax Act. 222A clearly states that if you distribute any assets to the shareholders, in case of a share, if you distribute any assets to the shareholders, now it is considered as deemed dividend. Similarly, there are multiple other angles to this point. We will discuss them tomorrow. Today, what you have to do is only two things. They are done with capital gain. You can solve every question of capital gain right now. Okay? I have shared you the list of DPQs, important questions. If you do not want to solve the entire chapter, just to solve the questions that I have asked you to solve in the important questions list. Apart from that, do solve the DPQ. DPQs are the essence of the batch. I'm telling you, the concepts you are already aware. Question answers you will get from somewhere. But DPQ practice that I am requesting you and the DPQ suggestions I give you now will help you in improving as to how do we solve that answer. Okay. Two more pointers. First thing, if you have not enrolled for the batch, a humble request to enroll as soon as possible so that you can be given access on time. Second thing, if you are enjoying this batch, share it with your friends, share it with the juniors, because anybody coming live is appreciable. Anybody who is watching it live or recorded, I'm saying now, any day you are watching, if it is not the 12th day, 13th day, 14th day, now you can come live. If you have missed out any lecture, that's okay. You will understand the next lecture. We take things from so scratch now that you will be able to understand everything without knowing any prior knowledge. And from tomorrow onwards, the topics will be so independent that without understanding the last lecture also, you will be able to understand everything. So if you miss out anything now, do come live the next day. Do come live. Okay? It is okay. I am okay if you missed out first three lectures as well, you can come live. Last thing, books. I will talk to team. I will message you out. If you have not received the link for the Telegram channel, that will also be shared to you on mail only. If you have enrolled, you will be provided access today or tomorrow only. You don't have to worry about. You don't have to hurry about. We will have 2 more lectures on YouTube. And I can assure that even if one student has not received, one student has missed out on receiving the access, I will take more lectures on YouTube. You don't have to worry at all. Don't worry at all. I know as a student what issues I used to face, but I try to avoid those issues with the students. Even if I'm required to take 10 lectures on YouTube, I will take if students do not receive the access. Of course, team is issue. It must be having some issues, therefore they have not sent. But of course, I will take 10 lectures on YouTube. They will be unlisted ones. They will be private ones. I will be sharing you the link along with that. You don't have to worry at all. Okay? Your duty is to just study. Just study, solve question answers, solve DPQs, and come with a smiling face. DT is to be enjoyed. Okay? Learning is important, understanding is important, solving is important, but enjoyment is important. Okay? You understand that today's last half an hour, I just enjoyed the session. I didn't teach anything. You understood that point. And I will do this throughout the batch. I will do this throughout the batch. Despite of that batch goes to just 90 hours. And you understood how easily in 3 lectures only we did capital gain, we did basics also. We do things on time. We will be able to do. You don't have to worry about anything. You just have to come with a smiling face, prepare with question answers, write DPQs, read concepts, and share it with your friends. Okay? Bye bye. Love you all. See you guys tomorrow at the same time, morning, with same energy, excitement, and enthusiasm. Bye bye. Have a great day.